Okay, so welcome to video number 2 of the IPLT video series, our introduction to professional level trading. So, what did we learn firstly in video 1? Well, we learned some of the main differences between professional traders and retail traders. And of course, as we went through that exercise, we started by default learning some of the nuances of the landscape of the financial markets industry. And as I mentioned in video 1 at the beginning, our introduction right at the beginning, as I mentioned there, the industry has to be understood by all participants in order to progress. You have to not only understand the differences between the way professional traders and retail traders approach financial markets, but also you have to understand the infrastructure of financial markets themselves. So, just as a quick summary, what did we actually learn in video 1? Well, we learned that professional traders are different in that their approach to financial markets is different than the perception that retail traders actually have. So what are retail traders trying to do here? Retail traders are trying to emulate what they think professional traders are doing. But the reality is that professional traders are doing things very differently to the way retail traders actually perceive that they do things. So we learned very quickly that the real definition of professional traders is an investment bank prop trader that is from the pre-Volcker rule period and or a long-short equities portfolio manager, or in the wider remit of all financial instruments, long-short portfolio management. And of course, one of the main differences is that retail are part-time and professional are full-time. Retail have a misperception of what professional traders are actually doing. Retail traders think that professional traders are extremely short-term traders, or they have very concentrated risk and they're always going for very big wins. That's not the case. It's not reality. The reality is that professional traders are seeking consistency, long-term consistency in strategy and returns. But retail traders completely misperceive what is actually going on, whether that's down to popular media or media online. It's obviously a combination of many factors, but this is the perception that retail traders have, and it's totally misplaced. So what do retail traders actually go and do? Well, they have very concentrated risk and they tend to have very small amounts of positions. They're going for very big home runs all the time, very big wins, taking large amounts of risk. And they're doing this either in a very, very short-term time horizon, or they're doing it in an investing time horizon. Professional traders, completely different. Professional traders, we're trying to position ourselves in areas of the market where we can get consistency in returns, and therefore we must have consistency of strategy. Retail are going for the big wins. They're looking all the time for the big wins, concentrated risk, and also in terms of time horizon, either going very short term or looking at extremely longer term investments. They're not actually trading, okay? So, what are the other differences? Well, retail traders think for some reason that a trading account is something you take income from, that it's a income generating machine. It's not. Professional traders look at it completely differently. We look at it in a way where we say, okay, the market dictates my opportunities. And I'm not going to be able to take an income from trading because it's volatile. I can have up days, I can have down days. I can have up weeks and down weeks. I can have up months, I can have down months. I can have up years and down years. If I take income and I rely on my trading account for income, what's going to happen? Well, when I'm making lots of money, I'll take income. When I'm losing money, I'll take income. What I'm doing is I'm providing a headwind to the returns of my trading account. I can never ever actually continually get success in the trading account because I'm putting a ceiling of possibility on the trading account. And unfortunately, that's what retail traders do. Retail traders do this all the time. They've been sold this dream that your trading account and financial markets, you just show up every day, you place a few trades, you always make money, and then you take income from your account at the end of the month to make your mortgage payments, pay your rent, make your car payments, pay for your kids' school fees, pay for your healthcare. It's obviously nonsense, guys. It's nonsense. Professional traders just don't do it. Professional traders, we don't rely on our trading accounts for income. We build infrastructure that allows us to cover basic costs, like basic salaries, like basic income. And the returns in the trading account are not touched at all for income. In terms of risk, what are the differences? Well, we mentioned that retail traders love a bit of concentrated risk. Professional traders, we love diversification, but we don't take too much diversification. Obviously, we diversify enough where we are managing our risk sensibly, but we don't diversify too much where we can't get good returns. But there's a very, very important point here in terms of risk management with a difference between professional traders and retail traders. When professional traders are winning, we seek risk. We take more risk. When we're losing, we seek less risk. We take less risk when we're losing. Retail traders, what are they doing? When they're winning, they're taking money from their trading account to take income when they get wins. And when retail traders are losing, they're taking more risk so they can try and get bigger gains because they're getting more desperate to get a return. So there's obviously some very big key differences between professional traders and retail traders. And what it comes down to here, guys, is that if you engage yourself in all of the behaviors that retail traders think they should engage in because they're trying to emulate this dream, this perception that professional traders, they engage in all of these behaviors when they actually don't. What is going to happen is you're never ever going to get up the competency hierarchy. You're just going to go round in circles all the time, and you're never going to get better. You're never going to get what professional traders are actually aiming for, which is long-term, consistent returns. So we introduced you to that competency hierarchy. And unfortunately, guys, there's no shortcut here. There's no way around it. If you want to climb the competency hierarchy and get to a level of professional trading standard, you're actually going to have to really digest and understand the differences between pro traders and retail traders. You're going to have to totally understand the retail trading infrastructure and financial markets infrastructure and where you fit in and why it's so difficult for retail traders to actually break through the competency hierarchy and get to a level of a professional trading standard. Unless you know those things, you're not even going to be able to begin to climb the competency hierarchy, okay? And lastly, you have to understand volatility. Now, we're going to get into volatility in the next video. In this video, we're going to take a deeper dive into the differences between pro traders and retail traders. So you really get this. You've got to really understand it in order to climb the competency hierarchy. So let's get into this video. Video number 2, professional traders versus retail traders 102.
Okay, so welcome back to the screen. Welcome to video 2 of the IPLT, Professional Traders versus Retail Traders 102. We're going to continue now looking at the differences between professional traders and retail traders, but we're going to dive a lot deeper. So overall in the video series, we are introducing you to the differences between retail traders and pro traders to give you that foundation, to try and help you lift yourself up from unconscious incompetence. In this particular video lesson, what we're going to do is dive much deeper into those key differences. So we have a lot to get through in this particular video, a lot of key concepts in terms of the differences. We're also going to have a look at a lot of your old bad ideas as well and actions that retail traders engage in. But let's get started with a major key difference between professional traders and retail traders in approaching financial markets. Let's talk about alpha and beta. Okay, so let's get these definitions down right away. Very quickly, market return is known as beta. And any excess return above the market return from a trader's or investor's portfolio is called alpha. So let's have a look at a few examples here. So let's say the market is up 15% in a year and you manage to return 25% in your portfolio. Well, that just means that the alpha that you've generated is 10%. So 10% return above the market return. Let's have a look at another example. If the market is up 15% in a year and you return 5%, then what happens there? Well, in this situation, your alpha is negative 10%. So in our first example, 25% return, alpha is positive 10%. In our second example, alpha is negative 10%. So if you get a 5% return and the market's up 15, you're negative 10 alpha. Now what happens if the market's down 15% in a year and you return minus 5% in your portfolio? Well, your alpha there is actually positive 10%. You've outperformed the market by 10%. We'll come back to that in a second. What happens if the market's down 15 and you return negative 25? Again, this is an example of a negative alpha. So your alpha as a trader in this example is negative 10%. But let's have a look at this scenario here in a bit more detail where the market's down 15% in a year and you return minus 5%. Well, we're calling that a positive alpha, but how the hell is that positive? It just isn't, right? Because you lost money. And this is something that professional traders really understand and focus on. This is why pro traders tend towards what we call a long-short mandate. That's so we can make money when the market goes up and goes down. Now, overall, alpha is a very, very important number if your mandate is long only. So let's say you're only buying stocks, market goes up, you want to know whether you outperform or underperform. And if you outperform, you have positive alpha. If you underperform, you have negative alpha. For traders who have a long-short mandate, alpha is not that important. Let's have a look at an example. So our point of origin, the value is 100. Over 5 years, what happens? Well, we compound that 15% over those years, and we get to an index level of 201. This is great. If you're a long-only pension fund holder, you've basically doubled your money. But what happens in those periods, every 7, 8, 9 years, when we go into a bear market, when the business cycle turns, when the market goes down 50%? Well, what happens? Well, the value of that index just halves again. So over 6 years, in this situation, you've essentially made no money. So if you have a long-short mandate, and let's say you underperform the market by 3% a year. So we're making the assumption here that we're actually not that good at the long short mandate. Let's say that happens in the 5 years when the market is going up 15% every year. But in that year 6, when the market halves, you actually go and make 40%. There's obviously a massive swing. So let's work out the numbers. What actually happens in terms of the performance swing? Well, over those 5 years when the market's going up 15, you're basically up 12% every year. But in year 6, you're making a 40% return. So overall, in 6 years, your index level, the value of your portfolio is at 247. And the index level remained at 100 over 6 years. So what does that mean? You've got 147% outperformance. But obviously what's quite interesting, and this happens in recent business cycles, for the 5 years that the index is up more than your returns, where you're making 12% a year, for those 5 years, all of the idiots in the market who don't understand how this works believe that you're no good because they're reading, for example, your relative returns to the market in newspapers like the FT and the Wall Street Journal. What they don't understand is that this is all to do with risk-adjusted returns. What if the trader who is returning the 12% per year is actually taking less risk than the 12% that they're getting each year? The market risk is just the market risk, okay? That's the headline risk of the market. If the market's up 15% in a year, that's probably very accurate in terms of the risk that's being taken at the market level. But what if the guy who's making 12% per year is, for example, taking 7 or 8% risk per year? You see, that can be seen as a very positive thing. Now, of course, in a market that's going up, let's say 15% a year, you can actually choose the level of risk that you want to take. If you go into the market, the 15% is just a somewhat of a blended average in terms of the constituents within the market. And bear in mind here, we're talking generically and loosely here in terms of what we refer to as a market. The constituents of that market, there will be many constituents that are up a lot more than 15%. Okay. So, of course, as traders, pro traders, we look at it and we say, okay, well, when the market goes up, we should be taking more risk and going for bigger returns. When the market goes down as well, we obviously want to outperform. So we want to outperform on the way up, outperform on the way down. In short, what are we saying here? We just want to make a lot of money, okay? Whether the market goes up or the market goes down. This example I'm using here to highlight the kind of baseless hubris of long-only relative measures versus the long-short mandate. And also to highlight that, just looking at things purely through the lens of alpha, it really isn't that important. So what is obviously way, way more important is just whether you've made money or not, okay? Have you just made money? We refer to this in the industry as absolute return. So absolute return and your risk-adjusted return is far, far more important than alpha when it comes to being a trader, okay? Now, something that we're going to introduce you to properly now, the Sharpe ratio. What is a Sharpe ratio? Sharpe ratio measures basically the amount of return that a trader or investor gets out of the risk that they're taking. So what return do you get for every unit of risk that you take? So if we consider the market risk, let's say, is 15%, and an investor is long only, if their return is 15%, then their Sharpe ratio is simply 1, just 15 over 15. Now, we can't obviously accuse them of not making money. They've undeniably made money, but they've taken 15% risk to get 15% return. But what happens if you actually just go and lose money? What happens if you're down? What happens if you lose money trading? Well, an investor or trader that just loses money obviously has a negative Sharpe ratio because their return is negative. So a negative divided by a positive will give a negative. So negative Sharpe ratio in this scenario. Now, the sad news is that the vast majority of retail traders globally lose money. So, for example, outside the US, in long-short CFD trading, contracts for differences, that's a product that international retail traders tend towards. They are derivatives contracts. We won't go into the details too much here yet. Outside the US, international guys who are trading CFDs, 95% of retail traders will lose all their money trading those products. And actually, the best numbers in the United States, so like the top end statistics would be around 75% of retail traders losing money. So globally, in equities, equity options, and CFD trading, which are basically derivative contracts that are the prices are derived from the underlying securities. So things like equities. Globally, 75 to 95% of retail traders at any one time are just down, losing money. They're pretty much out the game. Okay. So what does that mean? Well, it just means that all of these guys have negative Sharpe ratios because they're taking a certain level of risk and they're getting negative returns. So they're negative Sharpe all the time. Okay. So for a retail trader, just actually making money in a long short portfolio and having a positive Sharpe, even just between 0 and 1, is absolutely the first challenge for all retail traders, just to make money. And then it obviously doesn't stop there. There's a second challenge, which is to try and make a higher percentage return than the risk that you're taking in all market conditions. So whether the market goes up or the market goes down. Now, of course, we would just all, as rational, logical people, just like to get paid in financial markets every day with no risk and just make a good or same amount of money as everyone else, taking lots of risk. But that, in reality, is obviously impossible. In reality, we have to seek out risk. We've just got to accept that we have to take a certain level of risk in order to get a return, okay? We have to expose ourselves to volatility and therefore to get the opportunity. So volatility is essentially two sides of the same coin, which is risk and opportunity. We have to take risk in order to get the opportunity, and wrapped and taken together, we call that volatility. Now, we're going to introduce you to a term here. Don't worry about the definition of exactly how this works yet. You're going to learn this as we go through the IPLT. We're going to introduce you to this term called standard deviation. And you can actually calculate standard deviation, the volatility of a portfolio practically, and you can actually figure out the annualized standard deviation or annualized volatility of a trader's portfolio. So let's have a look at two theoretical traders here and just ask the question, where would we rather be? What type of trader would we rather be? So let's have a look. Trader 1 has an annualized standard deviation in their portfolio of 30%. And the return that they get from that 30% is 20% in 1 year. So annualized standard deviation, annualized volatility of the portfolio is 30%, and the trader gets a 20% return. Then we have trader 2, where their statistics say they have an annualized standard deviation in their portfolio of 13%, and they get a return of 19% over 1 year. Let's think about this. Who is the better trader? Which trader would you rather be for the rest of your life? I'll give you 5 seconds because it's not that difficult to work out. Of course, you would much rather be trader number 2. If we work out the Sharpe ratios for each guy, we can see there's obviously a stark difference. The Sharpe ratio for trader 1 is 0.66. The Sharpe ratio of trader number 2, where we take the 19% return over 13% risk, 13% volatility, the Sharpe ratio of trader number 2 is 1.46. Now, if you're a decent retail trader, it just means you make money. Okay? Not necessarily having a return that's higher than the risk that you're taking. Typically, even good retail traders, the significant minority, will still be taking more risk than the return that they're getting. Okay? So they've conquered the first challenge to an extent, where they've managed to just make some money. But the second challenge of getting a higher return out of the risk that you're taking, they're failing at. Okay. So this is in the significant minority of retail traders. So understand that first. Okay. And they're not necessarily doing anything right. A lot of the time, it's just down to one-off gains or luck or something's happened. We know they don't have processes that give them consistency over many, many trades over long periods of time. So do bear in mind, this is the significant minority of retail traders. So in the best case scenario, where you're a retail trader and you're just making some money, it's very typical that your Sharpe ratio is going to be between 0.1 and 1. They're making money, but they're taking way more risk to make the money and get the return that they're getting. They're basically totally inefficient. Now, all good traders will have a Sharpe ratio above 1. They obviously firstly make money, but they get a higher return from the risk that they're taking. Professional level traders, human traders, tend to have Sharpes above 1.5, but cap out over many trades over a long period of time, somewhere between 2 and 2.2. That is a very typical Sharpe ratio of a good, solid, professional trader. Now, all of these algorithms that trade gazillions of times a day, 20,000 times a second, tend to have Sharpes between 1.5 and 3. But most algos lose money. These are the ones that actually make money. Those that do make money have high Sharpe ratios because they're in and out of the market very quick. They're taking very low risk to get the returns that they're getting. They have a high Sharpe ratio of between 1.5 and 3. And generally speaking, the algos that get those types of returns, they won't get them for a very long time. Why? Because all of the other algo traders, all of the other programmers will work out how they're getting that return, and they will out-machine their competition. So what we have to concentrate on here, at the end of the day, we're not programmers right now. We are professional level human traders. What we want to do is obviously make money, and then make money in terms of the return that we get. We want to make money and take that's in terms of return that's higher than the risk that we're taking. Okay, that's what we have to conquer as teachers, showing you how to move from the retail world to the professional world. Now, let's have a look at another simple concept that we have to wrap our heads around as traders. Let's have a look at the evolution of our returns and what that might look like. And I'm going to pose a question for you here. We have trader A and trader B. Trader A is the blue line, trader B is the orange line. And this is your equity curve as a trader and the evolution of your cumulative dollar profit over time. Okay. So the question I'm going to pose here is, who would you rather be? Would you rather be trader A, option A, where you're the blue line and over time, let's say this is months, months 1 to 20, you're the blue line. In month number 1 to month number 8, you're actually losing some money. And then you take off 8, 9, 10, 11, 12. So between month 8 and month 20, that's where things start to get good for you. Or would you rather be trader B, option B, where you are the orange line and it's just a almost 45-degree straight line of profit? Now, note, both traders end up in the same position. So they start in month 1, same position, and end up making the same amount of dollars. You can see that on the chart where the blue and the orange line meet. So I'll give you 5 seconds. Who would you rather be? Okay, so those of you who say you'd rather be option B, of course, you're correct. But I've got news for you. It's actually impossible. You can't achieve that. That in the industry is what we would call the Bernie Madoff equity curve. It's a fraud. If you ever see somebody with an equity curve like this, ask some serious questions. If you see someone with an orange line equity curve like this, the reality is that you're going to have volatile returns, a volatile cumulative dollar profit. That is just reality. That's what's going to happen. So overall, the evolution of your equity curve as a retail trader or professional trader, it doesn't really matter. You're going to have your ups and downs. The good news is you can choose the level of volatility that you want to take. So the first challenge here, in conclusion, is to just make money. We need to make money as traders. The second challenge is to make a higher percentage return than the risk you're taking, whether the market goes up or down. We are absolute return. We are, to a very, very large extent, agnostic to what the market is doing. If the S&P 500 goes up for a month and we make more money, we don't care. Who cares what the S&P 500 is doing? We don't care. We are agnostic. If the market goes down 5% in a month and we make money, we don't care. The market return is irrelevant. We are agnostic. We are absolute return traders. And on top of that, we are fully aware and understanding that our equity curve, our cumulative dollar profit, is going to be volatile. We accept that. But what we do is we choose the level of volatility that we are willing to accept in our portfolios. Therefore, we choose the parameters around the evolution of our equity curve by default. Now, let's have a look at the time horizon spectrum and in terms of differences between retail traders and professional traders. Now, the reason why time horizon and the time horizon spectrum is so important, and we have to cover it here, is because retail traders genuinely misperceive where professional traders lie on the time horizon spectrum. Let's for now just have a look at the time horizon spectrum and just figure out the differences between retail traders and professional traders in this respect. What we have here, first of all, is on the top of the time horizon spectrum slide, the number of days a position goes on for, okay? So we have 1 day, 5 days, so 1 trading day and 1 trading week. Then we have a trading month, which is 20 trading days. Then we have 60 days, 3 months. Then we have 120 days, around 6 months, and 250 trading days, 1 year. And then 3 years and 5 years. So what do we actually define the time horizon spectrum as in various areas of the time horizon spectrum? Well, essentially, trading is very, very short term. And the longer we go, the more of an investor we become. Okay. So if you're trading for a minute, essentially defined as a trader, if you're taking a position for 5 years and then exiting, you're no doubt about it, an investor. And there are very stark differences between the way retail traders position themselves in the time horizon spectrum and professional traders. So what you'll often find is that retail traders are either one end or the other of the time horizon spectrum, or they're in both areas. So let's have a look. Retail traders are generally very, very short term. And you can see we've positioned them within the 1 to 5 day time horizon. Typically, retail traders are essentially taking positions for either within 1 day overnight, making 2 days, or no more than a week. Very, very short term. Or they are all the way on the other end of the spectrum where they become retail investors. So they're taking positions for, say, 2, 3, 5 years. And typically what they're doing when they short-term trade, they're in the majority following technical analysis, price action, and news flow. And when they are investing, they're basically looking at income and value investments, so dividend investments, and for looking for long-term value. So maybe they've read books, Intelligent Investor, Benjamin Graham, listen to Warren Buffett, stuff like that. Or they're reading technical analysis books that they're buying off Amazon and learning how to trade very, very short term. Now, there's a couple of problems with this. Professional traders don't do any of it. Okay. So when retail traders are going into the financial markets, they're taking a totally different approach to what professional traders take. So retail traders, if they're going very, very short term, what are they doing? They're trading typically in a corner of the market that they perceive to be a lot more volatile than it actually is. And they're also competing against something that they cannot possibly win against, which is algorithms. So, this short-term day trading and scalping approach, scalping order flow, has been dead now for over 15 years. Retail, for whatever reason, they're either one end of the spectrum or the other. A lot of these strategies have been popularized by, Warren Buffett becoming the richest man in the world. But hey, that's just one guy, okay? And his period was the 1950s to the 1990s. The last 15 or 20 years or so, value investing has been dead. Income investing, on the other hand, is dividend investing. That's for retirement. This isn't to make, consistent money over and over again every month, okay? This is not defined as trading. There's a big difference between trading and investing. The problem with retail traders is they blur the lines. So what happens when you open a retail trader's trading account? You'll typically see lots of short-term positioning, and then they might have a retirement account that's separate, or they blend in their investments into their short-term trading account. The point is that with longer-term investing, you're not defined as a trader. You're not positioning for trading. You're positioning for investing. Big problem with that is that you actually have to sit around and wait for 3 to 5 years to find out if you're actually going to be wrong or right. So the question is why sit around for 5 years to find out that you're wrong or perceive that something is cheap? You go and buy it on a 3 to 5 year investment horizon. And then you get to year 3, it's not worked. You get to year 4, it's not worked. You get to year 5, it's not worked. What do? Well, you just wasted 5 years. That capital could have been used to do something else. Okay, there's opportunity cost always. What happens if you go into the market and you work 9-10 hours a day an hour or two pre-market, an hour after. You're sitting at your screen all day for 8 hours staring at the screen, and you get to the end of the year and you've made, at best, we're talking here like top 1 or 2% of day traders. You've made at best a salary. Professional traders find that ridiculous as well. So the key difference here, guys, is that retail traders perceive that traders are extremely short term. So they go into the short-term market and compete against algos, and they play a game that they cannot win. And to hedge themselves in the long term, they also have investments. They have no clue what's in between. Now, if you look at the time horizon, you'll see that we've labeled here the definitions of each time horizon. So above 120 days, we label that as investors. Below 20 days, we label that as trading. And then in between, there's an area with long-short portfolio management, which is 20 to 60-day time horizon. And then there's a gray area of 60 to 120 days. Essentially, what we're saying is that there is a volatility sweet spot that professional traders take advantage of, where they take the best disciplines of trading and the best disciplines of investing, and they combine it in a situation where they have a systematic process that creates consistent profitability from the volatility sweet spot. Also, on top of that, it's the best area to learn, okay? Because you're actually learning the best disciplines of trading and investing. If volatility increases, your approach can be amended slightly and you can slide down the time horizon spectrum to become more of a trader. If volatility decreases, you then move back into the long-short portfolio management area. Now, there's a key issue here, which is something that retail traders really have to face and understand, okay? If you take a position, going into a position with a 20 to 60-day time horizon, what we mean by that is you enter the position with the intent to take advantage of the 1 to 3 month volatility. And then you still have that position on after 60 days. It is starting to become an investment. So between 3 and 6 months, that's when your trading position starts to become more of an investment. And you have to be extremely honest with yourself. Now, everyone's always looking for a rule book. Anton, tell me exactly the day when something becomes an investment. There's no rule book here, guys. Rule books don't exist, okay, when it comes to stuff like this. Everything is situational. Next question we always get is, when I take it off, can I put it back on? Well, the key difference here, guys, between a trade and an investment is something that's going to move the stock within the 20 to 60-day time horizon, okay? Something that's going to move it. We call them catalysts. We do go into catalysts in additional video series at ITPM. So the PTM video series and the options trading masterclass as well, the POTM. But just take for granted here, guys, in the IPLT, while we're learning about the differences between retail and professional traders, that the difference between a trade and an investment is catalysts and volatility that essentially occur in the stock within the 20 to 60-day time horizon. That is the difference. Now, in this area here, the 20 to 60-day time horizon, that's where pro traders exist. We exist in this area, okay? And we know that when we try to capture the volatility in this area, what we need is a pro trader systematic process for long short portfolio management within that 20 to 60-day time horizon. And this is essentially what a pro trader systematic process looks like. We split it up into two big areas, theory and implementation. And within the theory, what we're doing is that we're learning how to find a trade idea, okay? This is the vast majority of what you will do as a trader. You will learn how to implement this process, but first you have to learn the theory. You have to learn the theory of how to find a trade idea. And fundamentals are in the vast majority of what we do. Like we said on the previous slide, the best disciplines of trading and investing. There's a perception out there from retail traders that if you're an investor, it's 100% fundamentals. That's all you focus on. If you're a trader, it's 100% technical analysis and price action. That's all you focus on. Incorrect. The perception is wrong. Professional traders who exist as long-short portfolio managers in the 20 to 60-day time horizon, we exist in the majority in fundamentals and the minority in technicals and price action. So we're looking at 80 to 90% fundamentals, 10 to 20% technicals and price action. Fundamentals is in the vast majority of what we do, but we do use both. So we combine the best disciplines of investing and trading. Now, if we look at the screen here and we look at fundamentals, how do we actually go about generating trade ideas, high quality trade ideas, utilizing fundamentals? Well, it's a two-step process. Firstly, there's the quantitative rigor, quantitative process. And then secondly, a qualitative process. Again, we're not going to go in the IPLT video series into any depth of how you actually do that. What we're doing in the IPLT, as we've mentioned previously, is initially looking at the key differences between retail traders and professional traders. And then we're going to be putting some numbers on it. So giving you some tools where you can begin to really understand the difference. So you can get from that level of unconscious incompetence and start climbing the hierarchy. Fundamentals are the most important thing. Now, I'm going to introduce you to a small concept here where if you take a position fundamentally in something that you're fundamentally bullish on, okay, and the position that you take, you end up shorting the stock because you looked at the chart and it doesn't look great for 1 week, okay? That is the cardinal sin in trading. So imagine the stock that you're bullish on fundamentally goes up and you're short because you looked at a chart. Of course, that's the cardinal sin in trading. Why? Because your view has turned out to be right. Your fundamental view has turned out to be right, but you lost money. That's a sackable offense at institutional trading firms. If you walked into a room and said to your boss, I'm fundamentally bullish on something, but I'm short overnight because I think the stock will go down tomorrow, and then overnight the company got taken over, you're going to look like an idiot and you're going to get fired, okay? This is something retail traders don't understand, because professional traders, we have a process where when we identify something that we're bullish on, we just will never short it until our fundamental view changes. It may change in the future, okay? But this is a good example to start off with, because it shows you the understanding that professional traders have when they put most of their work into fundamentals, and we end up with what's called a fundamental bias. And we never go against the bias unless our bias changes. Now, let's say, for example, you are fundamentally bullish on something. What would you do if you've been through the quantitative process, the qualitative process, and you've identified something that you're fundamentally bullish on, but the timing doesn't look right? So the technicals and the price action don't seem right at the time. What would you do? You would probably just wait. You just wait for it to get a better timing. What retail traders don't understand is that professional traders do it the other way around. We don't look at charts to generate trade ideas and then look for fundamentals to justify the chart. Charts are backwards looking. Fundamentals are forward looking, okay? Our job is to try and predict the future and try to capture that volatility in the next 20 to 60 days, okay? Retail traders are upside down. They do everything backwards, okay? The majority of the process is in fundamentals for trade idea generation, 80 to 90%. Retail traders are doing it the other way around. They're putting 80 to 90% of their work into technicals and price action to generate an idea, and then looking for the minority of fundamentals to justify their position. Technicals can be used, of course, but in a limited sense. Okay. Technicals and price action are used by professional traders for timing and timing only, timing something that they already have a fundamental bias on, a fundamental predisposition. Now, once a pro trader that's utilizing this systematic process decides, okay, I'm fundamentally bullish on something, the timing is right, I'm ready to go, what's next? Next up is implementation. You have to consider the trade structure, and you have to consider the catalysts and when you think they're going to occur, and build the trade structure around that. So you've got the fundamental tailwind behind you, you've got the timing, and now you're looking at the trade structures that are situational to the specific situation that you're about to take a position in, that you're about to trade over the 20 to 60-day time horizon. What you have to do is identify catalysts that are additional to earnings announcements. Earnings announcements are publicly available or publicly known events. The whole market knows it's going to happen. So typically volatility gets priced into the market around earnings announcements. What we need always is additional catalysts that are going to get the stock or get it moving in those 20 to 60-day time horizon. Okay. Again, we're not going to go through exactly all these catalysts and, give hundreds of examples of what they are. That's reserved for later in further video series like the PTM and the POTM. In the IPLT, we're just understanding again the differences between retail and professional traders, so you can start climbing that hierarchy. Identifying catalysts additional to publicly known catalysts. What would we be doing? We'd be going through the options calendar to see if it's worthwhile to take options positions or go into an option structure around the trade, if there's any marginal benefit in doing that over owning the stock outright as a long or or going short. So the marginal benefit of putting the structure on over just being long or short. Okay, if there's a better risk reward scenario that we can play given the situation that we're about to trade. Again, there's no rule book here, guys. This is where it becomes extremely situational, dependent on the catalysts and fundamentals that you're exposing yourself to. Okay, and the trade structure leads us into the next part, which is risk management, because the trade structure, to an extent, would actually give you an edge preemptively in the risk management of a position. But let's say, for argument's sake, that you now have the position on, and you now have a portfolio. So you've got a number of positions on. Well, your risk management is, it's got so many considerations around it. So firstly, the best way to look at it is breaking it up into things that you can do before you have a portfolio. So rules that you can put in place, or parameters that you can put in place preemptively, that basically stop you doing stupid things, that stop you having potentially big losses. Okay. And then there's reactive risk management, things you do when you have the positions on and then something happens. Piece of news comes out, whatever, something happens, and the position either becomes a winner or a loser in your portfolio. Typically, a long short portfolio in a retail trading infrastructure, so the size of money that's on margin would be between 8 and 12 positions. That gives you diversity. It gives you enough diversity where you're being responsible and you can't lose too much if one position goes badly wrong. But you're not too diverse enough where you can't make money. That's very, very important. There's an efficient frontier, especially for retail traders on smaller numbers, of around 8 to 12 positions. And reactive risk management, we've mentioned this previously, is essentially staying in motion, reacting to things that occur that are affecting your positions and making them either winners or losers. What we're trying to do all the time when we're staying in motion is to trade the probabilistic outcome. So when you look at something and let's say a piece of news comes out, you look at a position in your portfolio and it's affected that position and the position's now a winner. What action do you take? Do you sell some? Do you overwrite the position with some call options? Do you actually go and buy a bit more? What do you actually do? The thing is, guys, reactive risk management is, again, completely situational. It really just depends on the situation. What we're doing here is showing you for the first time a pro trader systematic process in the long short portfolio management 20 to 60 day time horizon in order for you to understand the differences between what a pro trader does and what a retail trader does. Think about this in the context now of what we're learning here. The differences between pro traders and retail traders. Have you ever seen a retail trader go through a process like this? Outside the institute, it doesn't exist, okay? People do not implement these processes in the retail space. And it's part of the reason, it's the main reason why they lose money, okay? Why the statistics are the way they are is because they don't have a robust and repeatable process that provides consistent profitability. But what they do have is randomness. And randomness, essentially, if we look back at our competency hierarchy, randomness is unconscious incompetence. They don't know what they don't know. They don't even know these processes exist. They don't know that professional traders actually use these processes. So what happens? Well, they just stay at the bottom. No clue what they're doing, but they think they do. It's delusional. They're in denial, and they're basically living a lie. So before we move on, the approach of professional traders, it's never changed. We always sit in that volatility sweet spot. If volatility increases, we may become shorter term and slightly change the way we do things. But when volatility comes down, we slide back up and we go back into that area. It's our crutch. It's what we can lean on. It's the area of the market where we know we can make good, consistent returns for a very, very long time, if not forever. And what it's about, guys, if you're a retail trader and you're trying to get, up the competency hierarchy to one day become very good at trading, it's about knowing the difference, first of all, and then learning how to emulate the approach yourself, but in the retail trading infrastructure. Now, a lot of people, because they obviously do have day jobs, run businesses, families, whatever that is, you're short on time. That's a reality for retail traders. You're short on time. The question is how the hell do I do this? How do I learn this? How do I implement it into my life? Why don't I just find somebody who does this already and then just copy them? Well, that's a big problem as well. People try this all the time. They try to bottom feed, jump on chat rooms, webinars, whatever, reading newspapers, looking at trade ideas on television, looking for their next trade idea, their source of information that's going to make them money. We call it copy trading, okay? Whatever form it is, it really just comes down to that. It's called copy trading. It never works and it's never sustainable. Why? Because when it no longer works, it just means that the entity that you've copied has lost money or blown up, meaning you have. Then you have to just keep moving on to another copy strategy until it blows up. The cycle just continues and continues, and you forever remain unconsciously incompetent. Newsflash, guys. All good traders learn how to do it for themselves. They do it themselves, okay? You have to learn how to do it for yourself and get the returns yourself. And that involves getting the right information first and the right mentors. It requires a lot of self-learning, and you've got to learn how to determine your own future. You have to become someone who relies solely on themselves and on self-determination. Now, of course, this does not mean learn how to day trade using technical analysis. We know that doesn't work, guys. It's the wrong information, okay? Again, the caveat here is if you're going to do this and do it for yourself, you actually need the right info. So if you don't have the right info, or you don't have the ability to self-learn and self-determine your own future in trading, what's the outcome going to be? If you don't have one of those things, if one of them just disappears, you're not going to be a good trader. It's just never going to happen. Following a few lines on a chart for passive income is just not the solution. It's complete delusion. And also, you're competing with PhD rocket scientists who build the algos, okay, that you're competing against. It is literally the reason why the statistics are the way they are. It's the reason why retail traders lose money. Your outcome is predetermined. It's just a question of time and amount of trades. You will blow up. And you've seen from the time horizon spectrum, and obviously the example of the pro trader systematic process, that pro traders do things very, very differently. Okay. Retail traders lose money because they're quite literally doing the exact opposite of what professional traders do when they're approaching the markets in everything they do. Now, we've all heard these statistics. We popularized the 90-90-90 phenomenon. We started putting that out years ago, way back in 2011. 90% of retail traders lose 90% of their money within 90 days. Okay. That's referring to all of the short-term day trading or day trading and short-term brokerage accounts in the US and internationally. And we've all heard the statistic that after a couple of years, only 3 or 4% of day traders will be around. Okay. There's a reason for that, guys. It's because people are doing everything in the opposite to the way professional traders do things. It really is amazing to us guys, to professional traders, that people still pursue these strategies, whether it's through ignorance or complete stupidity. And this is the thing, we understand as well that, for retail traders, it's not necessarily their fault. Okay. They get fed the wrong information by bad players in the industry and through the media. Okay. And also they've got realities in their lives. Most people have day jobs, or they run small businesses, small or medium-sized businesses. They're looking all the time, if they want to look for the quick solution that's going to make them profitable quickly. And then they can rely on that and just, do it a couple of hours a week or 1 hour a day or less. What it does is it obviously just leads to retail traders seeking shortcuts and hacks. So things like copy trading, things like buying a $20 book on Amazon on technical analysis, and then thinking that's going to make you turn $500 into $1 million. Obviously not going to happen. Okay. And the result is always you're going to blow up. Okay. There really is an entire industry built around that weakness, the weakness of the retail trader, which is you're short on time and you need a hack. Okay. The problem is it just doesn't exist, guys. It just doesn't exist. There's a whole industry built around it to exploit that weakness. And it comes from the bad actors in the industry. But, the good news is that there is an awakening occurring where retail traders around the world, certainly in the last 5 to 7 years, and we've been a big, big part of this, pushing out the right information and making sure people can understand the differences between retail traders and pro traders, and begin that journey of climbing the competency hierarchy. We've been a big part of that, and there is an awakening happening. You just have to keep going back to your objective and understand that there is a difference between the way pro traders do things and the way retail traders perceive they do, and the way retail traders end up trading. Okay. Go back to your objective and understand that. It's to make money regardless of market direction. Okay. Regardless of the noise in the market. However, obviously we know the vast majority of retail traders lose money. And we're going to start looking now at the reasons for that. Why? Because if we're going to really understand the differences between retail traders and pro traders, we need to look at all of the bad habits and all of the bad things that retail traders do, and their own understanding of financial markets, the traps that they fall into. And by doing so, you can obviously then move on to look at the way pro traders do things, understand the differences, and then emulate pro trading strategies in the retail trading infrastructure. So let's begin by looking at key players in the market that create scenarios for retail traders and set them up for failure. Let's look at the broker, the educator, and the retail trader. So understanding the infrastructure that you're about to go into, so the retail trading infrastructure, is super important, because it's almost as if the players in the market and the infrastructure itself is set up where parameters exist and messages exist for you to literally be indoctrinated into a way of trading and approaching financial markets that will never actually make you consistently profitable. So let's start with some definitions and understanding of how this works. Okay. When you open a trading account, you deposit money on margin. Okay. The deposited margin is literally the amount of dollars that you put into your trading account, and it's used as collateral to enable you to borrow when you trade. So when you borrow, we call that leverage. Now, we need to be careful here about wholesale blanket definitions globally, because the US domestic market and the way retail traders trade is slightly different to the international market. When you're outside the US as what we term as an international retail trader on an international trading platform, you're essentially trading derivative contracts. So contracts for difference or spread betting. You don't actually own the underlying asset. You own a derivative contract. The name is basically put together because as a derivative, because the price of the contract that you're trading is derived from the price of the underlying asset. It's supposed to mirror the price of the underlying asset. When you actually trade on the retail broker's platform as an international trader, you're buying and selling the contract. And it's important to understand that, because retail traders genuinely perceive that if they're going on a retail broker's platform internationally, when they go and purchase a stock, they genuinely think they're owning the stock. They're not. They're actually buying a contract that the broker sells to them in an off-market transaction. It's a derivative contract. And of course, the prices can differ. There can be latency where the stock moves and the contract doesn't. It doesn't mirror it all the time, 100% of the time, one for one. Okay. That's the first thing to understand. This is a good example of the differences between reality and perception that retail traders have on how the industry works. Now, let's get some definitions out the way. First of all, initial margin. That's what you deposit in your account to begin with. So if you open your trading account, the dollars that you deposit into the account. Variable margin is what's used as collateral on the outstanding positions when you're actually taking positions. So when you're using leverage. Now, inside the US, retail traders, it's slightly different. Retail traders, when they're taking positions in a stock, long or short, in the US, they can trade on margin, but they are actually taking positions in the stock. They are not derivative contracts. Okay. So inside the US, retail traders are trading on margin, and it's typically 2x, so 2 times leverage for overnight positions, or 4 times leverage if they close out the position on the same day. So it's not an overnight position. So you can see as well here, there's an incentive for people to actually go and day trade, because they can get more leverage in the US if they close out their positions before the end of the day than if they hold overnight positions. So of course, that situation there is encouraging people to take positions and close out before the day is out. Now, 2 times leverage is 50% margin requirement, and 4 times leverage is 25% margin requirement. Now, obviously, I've mentioned already that there are nuances and differences between international and US retail traders. It's all essentially the same, guys, but we'll go through international guys first. We'll come to the US guys a bit later, but it's extremely similar in the US to the international environment. All the same things, or very, very close to being all the same infrastructure that retail traders fall victim to exists inside the US as it does internationally. So let's have a look at an international example. And let's have a look at an international example in the Forex market, because Forex is more extreme, makes a good example because there's more leverage. So it makes a good example to highlight the point here about how retail traders perceive what is going on, but the reality of what is actually going on. So international example in the Forex market, typically Forex internationally is around 3.5% margin requirement. So let's go with 3.33%, meaning that if you take a $100,000 position equivalent, so a 1 lot size in Forex, your variable margin on that position is going to be $3,330. Now, if you lose, for example, 1% on the $100,000 position, you're going to lose $1,000 from your account. The broker literally takes that out of your account at the end of the day. So if your initial margin was $3,330, it basically means you're 30 times leveraged. And if you lose 3.33% on that position, the 100K position, you're literally going to be wiped out. So you can see you're dealing with very, very small margin of error here. Now, when it comes to initial margin, let's say your initial margin was 10K and you take that 100K position in Forex, your 1% variable margin, the $1,000, is 10% of your $10,000. That basically means, and you'll see this in the corner of your brokerage screens when you're taking positions, that basically means your utilized margin, and this will be a metric that's in the corner of your screen as an international retail trader, your utilized margin is 10%. So if you lose 1% on the $100,000 position, so $1,000, you're going to be down 10% on your initial margin requirement while the position is still open. So this number, utilized margin, that you'll always see in the corner of your screen, that's the broker basically telling you that you're utilizing only 10% of your margin on the position that's open. Now think about this for a moment, guys. If you put tons of retail traders onto a trading platform with this situation and these parameters that exist, and 90% of your traders, the retail traders on the platform, lose money, well, isn't that a great business if you can actually take the other side of those positions? Great business. Why? Because you're going to have a 90% win rate, making obviously a lot of money. So a lot of the time, the way these international brokerage platforms work, and we covered CFDs earlier, you're not buying the underlying asset. You're buying a contract. You're trading a contract that the broker is selling you. The other side of that trade is the broker. So when you're going long, they're going short, and they can choose whether to hedge out that position by trading the underlying or leave the position open. Now, if they know that 90% plus of their retail traders on their platform are absolutely going to lose, if they know that with a very high degree of certainty, then of course they're incentivized not to hedge. So it just stands to logic. Why would they? And it can obviously be argued that they're literally incentivized not to hedge questionable revenue streams, not just because they're charging money for certain things and for you to trade and for you to even be on the platform, but also because of the incentives that lie behind it, the incentives that it creates for the brokers. Okay. So there's essentially 5 revenue streams that retail traders really have to understand in terms of how the infrastructure is set up and how that differs in terms of reality versus their perception. So very, very easy to understand revenue streams, spread and commission. Now, obviously, there's commission-free trading platforms that are becoming more prevalent. We're going to get onto that soon. But it's really important to understand that spread and commission still exists and what it actually means, because a lot of brokers still do charge commission globally. I'm sure in the future, there's probably going to be more and more free trading platforms where they get rid of the commission number, certainly the commission number, but also possibly the spread number, as well. So got to understand that, guys, because it's just the bread and butter history of the business. And it's one of those things that you have to understand just to kind of start climbing that the competency hierarchy. Because once you start understanding how these brokers are incentivized, it starts to throw up many, many other questions, okay? And how it differs from the reality of professional traders. So spread and commission, we cover that quickly. It's very easy to understand. We'll get onto that in a second. The next one is the data business. So that is the amount of money that the broker makes by selling your order flow to hedge funds at a rate that's charged per trade. We're going to get onto that as well. Next one up is the financing turn. That is the broker basically taking a turn, so charging a difference between what they borrow from creditors, so from banks, to then give you leveraged finance to enable you to trade on margin. They make a spread. They make money on that. If they go to Citibank, for example, and get a revolving credit line for $250 million at 1.5%, they're not giving it to you at 1.5% per annum. They're charging a big markup. So there's an incentive there. That creates an incentive. And then lastly, this is more for international retail traders. This is the over-the-counter OTC gain. This is the amount of money that the broker makes by literally taking the other side of losing retail traders' positions. Now, spread and commission revenues, very well publicized and easy to understand. What's a bit more difficult to understand is just always remembering that if a broker is charging spread and commission, that the incentive is to make you trade in the biggest size possible as frequently as possible. Okay? That's it. They're incentivized by default to attempt to make you trade as much as possible in the biggest size possible because they're getting paid to do that. Okay? This is very easy to understand, but people just forget this so often. Of course, very well publicized, easy to understand, but just don't forget it, okay? There's also, obviously, the other revenue streams that we have to look at. Very few people understand the existence and the mechanics of the broker's OTC business, the financing turn, and the data business, which is more prevalent these days on the commission-free trading platforms. Now, if the only revenue streams were spread and commission, it's pretty obvious, right? The broker just makes more dollars the more clients they have and the more those clients trade. So the frequency and the bigger size they trade. So they're absolutely incentivized to make that happen if they're if they're charging spread and commission. So this is the number one conflict of interest in the industry. Let's take note of this. Retail broker incentive number one, there's a volume and size incentive to make retail traders trade in the biggest size possible as frequently as possible. Volume and size incentive, conflict of interest, number one. Now let's look at something that's not as well publicized and definitely not understood by retail traders at all. It's the financing turn. So imagine the broker, the broker exists solely on the basis that they can agree this credit line with an investment bank. Imagine the broker goes to an investment bank, gets a credit facility for $250 million at 1.5% per annum. Then they farm out on a wholesale basis the leverage that's coming from the investment bank to retail traders on their platform at a much higher annualized rate. You'll never know what they're actually paying themselves for the credit to the investment bank or what they've negotiated, but there can be a big difference. Okay, the most important thing to understand here is how it works and that it actually exists. Okay, and secondly, the incentive that it provides to the brokers. Again, trying to make you trade in much bigger size. They get paid a commission or spread on if they're charging that on the bigger number. And we'll get onto the data business in a minute. But essentially, if you think about it, if they're selling your data, let's call a spade. They're actually selling your order flow. They're calling it a data business, but they're selling your order flow. Of course, if they have this credit facility in place, they still want you to trade as much as possible because they're going to sell your order flow. Okay. So they're incentivized for this. This throws up so many conflicts of interest that the retail trader doesn't understand. Okay. But let's go through how this actually works. This credit facility that the broker engages in with the investment bank, the broker's not on the hook for it if everything goes wrong. Okay. They're basically transferring risk from the brokerage to the creditor, the investment bank, and the retail trader. So think about this. It's the actual creditor's investment bank's money that's at risk. The retail trader on the other side, if they take a position, like in the above example where they're highly leveraged, and then it goes against them and they get stopped out, they just lose all their collateral that they've deposited in their trading account. So what does that mean? It's literally just a transfer of wealth. It's a transfer of wealth. So the creditor provides the facility to the retail broker. The retail broker farms it out and takes no risk. It's the investment bank that's taking the risk. And then the retail trader takes the position, gets stopped out, and the broker keeps the money. That's the business, guys. Okay. Now, think about this as well. The credit facility that they've negotiated, they negotiate it literally on the basis of the money that's put in the trading account by the retail trader. So you show up to a brokerage platform internationally and put, say, $25,000 in your trading account. What happens? That's used as collateral to then trigger the credit facility that the investment bank is providing to the retail broker. And then the credit facility is given to you, the retail trader, and then you lose. So if you think about how this works, guys, you put up the money and finance your own demise. Okay. Simply by putting money into your trading account, you're essentially sponsoring the broker's ability to borrow from the investment bank via their credit facility and then lend it to you at a higher rate. You are the person that's financing this. Now, of course, the retail broker has to put up some capital here initially to actually get the credit facility. Are regulatory requirements that differ across the world, but you can probably set up and get that $250 million credit facility if you put up $25 to $50 million of extra collateral above the retail trader's numbers to cover the losses, potential losses, if all clients lose money very quickly or there's a big problem, and to cover regulatory capital requirements. So this money just sits on account. It's hardly ever used. Very, very rarely it just sits on account, and it's just to basically prove to the investment bank that there's enough money there in case all things go wrong for the broker and for the broker's clients, and they have to cover some of the client losses. There's been some cases in the past where there's been big trades gone wrong in the markets, and like thousands of retail traders have lost much more money that they've had in their brokerage accounts. The brokers have tried to call them to try and get money out of them, and the retail traders can't afford it. So then the broker has to eat the loss. That's what that money is there for. Now, with the over-the-counter gain situation, which basically refers to international retail brokerage platforms, much more than US. Okay, this doesn't go on in the US, but it does go on internationally, all over Europe, UK, Asia Pacific. This still goes on, and it's very prevalent. This credit facility that the broker uses, they use the credit to enable them also to take the other side of retail traders' trades. So they're essentially a liquidity provider. So they take the other side of retail traders' trades. Which retail traders do you think they want to take the other side of and not hedge the position with the underlying asset? Of course, the losing retail traders. They keep the difference that they make on the contracts for difference with losing traders. They keep the difference and they call it market making or liquidity provision profit. So think about this, guys. Think about the chain of events. You show up to a retail brokerage account, retail broker internationally, open your account. You deposit, say, 25 grand. Okay. That's step number one. Deposit money in your trading account. You're not only just sponsoring the broker's ability because you're putting up collateral to give you financing and take a financing turn. You're also sponsoring the broker to have the option to use exactly the same credit facility to make more money by taking the other side of your trades if you lose. You're literally incentivizing the broker to screw you. This is how the incentives lie in the industry, okay? So let's get it down. Retail broker incentive number 2. Provide third-party financing at no risk, by the way, with a financing turn. Use the credit line to then encourage retail traders to over-leverage and trade as frequently as possible. Then take the other side of losing client trades. The infrastructure creates clearly a massive conflict of interest. So very important to understand this, guys. Very, very important if you actually have the ambition to start climbing the competency hierarchy. If you don't understand this stuff, you're literally trading blind. Now let's have a look at commission-free trading. There's now a big rush to trade commission-free by retail traders, and they actually believe that if they trade for free, they're more likely to succeed. They won't. And there's very simple reasons why. Firstly, the commission is not really a problem unless it's very high. The problem is how the retail traders are trading. Think about it, guys. Have the trading statistics for retail traders improved since the 1990s in terms of percentages that lose and percentages that win? They haven't improved at all. Think about all of the technological gains that we've made in the world over the last, say, 30 years. Okay? Think of all the software. Think of all the charting packages. Think of all of the access to news and information that retail traders now have compared to 30 years ago. And the numbers have never improved. Okay? Commission is not the problem. Okay? If the broker, realistically in the new world that we're operating in the retail trading infrastructure, if the broker charges a tiny commission, like 1 or 2 basis points, you going on a commission-free trading platform rather than paying 1 or 2 basis points is not going to make you a better trader. It really isn't. Okay. The problem is how retail traders trade, not the commission. Okay. The other issue is that it's not actually free. Okay. If they're not going to get you on commission and spread, they're going to get you somewhere else. All that's happened in this industry is that the guys who are offering commission-free trading have just shifted the business model to other revenue streams. The commission-free trading platforms that are currently out there are fraught with additional conflicts of interest. So they might not charge commission, but they've shifted their business model, and the conflicts of interest lie somewhere else. You will get charged. You are being charged. You are the product. So we covered the financing turn. It's even higher on commission-free trading platforms than the example we gave earlier. Okay, there's a popular platform in the US right now. We can't name names in this video series for legal reasons, but you can probably guess who they are. You can get it in their terms and conditions. Go on their websites, have a look at the terms and conditions, and see what you will pay for overnight margin lending. Okay, right now we're looking at 5%. They are probably borrowing at below 2%. Okay, so they're making a massive turn on the financing. Okay, 5% is 500 basis points. The way you work this out on a per day overnight lending is divided by 365 days. So you're basically paying 1.37 basis points per day. On $100,000, that's $13.70 overnight every day while you have that position on. The broker's making a huge spread in terms of wholesale lending when they get the credit facility and then farm it back out to retail traders on their platform. So think about this, guys. If you borrowed every night and over the weekend, so let's say you're fairly active and you're running a portfolio, okay, and you did that over 1 year, you're borrowing at 5%. So, $100,000 portfolio. So gross exposure in your portfolio. Let's say you've got 20 grand, 25 grand, 50 grand in your account if you're in the US. If you're taking $100,000 from the collateral that you've deposited in your account, $100,000 of risk, gross exposure, it means over a year you're being eaten 5%. It's going to cost you $5,000 in borrowing fees. So this means a few things, right? Obviously, there's the conflict of interest here because they just want to get you on the platform so they can lend you money, so they can make more money, okay, from the financing turn. But it also means that you're forced into day trading, okay? If you see money just missing from your account and you don't particularly know why because you haven't done the homework, but you take a 1 week position or a 1 month position and money starts just disappearing every day from your account and you can't figure out why, well, instinctively you're just going to trade more and more short term. Even if you figure it out, you're going to trade more short term. The broker's basically forcing you into very short term or day trading. Also, we haven't even discussed inflation. Fed target of 2%. If the Fed's hitting its target of 2% every year, okay, your $100,000 gross exposure in your portfolio, you're not just losing the $5,000 in borrowing costs, you're losing another $2,000. So your $100,000 at the beginning of the year becomes 93 at the end of the year. I mean, this is worse than obviously depositing your money at Chase and just getting paid nothing, okay? It's right now, I think the rate is 2 basis points over 6 months. So you literally would be better off just depositing your money at Chase, okay? So because at least you'll get the 100K back, and then obviously there's inflation to take into consideration, so you get back about 98. This is obviously prevalent in the US right now. It's very, very similar to the financing turn and OTC example internationally. And like I said earlier, guys, if they don't get you on commission and spread, they are going to get you somewhere else. They've just shifted the way the business model works to a more volume incentivized business in terms of the amount of clients that they get on their platform. So they're basically saying, come and trade on our platform because it's commission free. So people close their accounts at other brokerage firms where they're being charged a small commission, go to the commission-free trading platform, and then get destroyed on borrowing costs, right? This is the way it works. But as I've mentioned already, they don't just get you on the borrowing costs. The new business model of commission-free trading platforms is that they literally sell your order flow to hedge funds, okay? So think about this. If they know that the vast majority of their accounts, their retail trading accounts, so we're talking like 95 to 99% of retail trading accounts over like a 1-2 year period are going to lose money from the outset, then that's a valuable business, okay? Because they can sell the order flow of their losing accounts. And brokers have figured this out, that they can shift the business model and dangle a carrot in front of retail traders and say, we're going to allow you on our platform to trade commission free. So it creates a situation where a huge amount of people get interested because they don't do their homework and they don't understand how the business actually works. Okay. They get on the platform, they end up trading very short term. They end up becoming one of the statistics of the 95, 99% that lose all of their money within 1-2 years in their trading account. And in the process, the transfer of wealth is from their account to the hedge funds. So the retail broker acts essentially as a conduit for a transfer of wealth between retail trading accounts and hedge funds. The data is valuable to anyone that has the means to take the other side. They pay for it. They literally pay for the order flow. Why do you think they pay for it? Of course, because they're making money from it. They're making more money per order that they buy. They're making more money on trading and taking the other side of the losing traders than they do when they pay for the actual data, for the order flow. So they're making a profit out of this. It's a business. It exists, it's reality, and you have to understand that it, first of all, that it exists and how it works. Only then, once you've really understood how the infrastructure works, can you understand incentives and then understand why professional traders don't engage in this type of stuff. This is going to help you go from unconscious incompetence and start climbing the competency hierarchy. Let's continue. Let's conclude on commission-free trading platforms. The commission-free trading platforms are literally enticing retail traders using the trade for free slogan as a marketing gimmick. It's just a marketing gimmick, okay? To get retail traders onto their platform and then get them addicted to day trading or short-term trading and losing. They're getting you addicted to losing. We have this phrase in the Institute, we call it lossaholics, okay? People who are addicted to all of the false narratives and addicted to losing, okay? I guess it's interchangeable with unconsciously incompetent, okay? People are addicted to losing. Retail traders love it for some reason. They love the narrative. They believe in everything that they're told. They go on the platforms and do exactly what they're told to do by the owners of the infrastructure, okay? Professional traders do not get involved. We understand it. We know it exists. We stay well away from it. This commission-free trading platform model, it's obviously mostly prevalent in the US, but it's very similar to the international financing turn and OTC gain, as we've seen. Small difference, instead of offering the credit from a third party risk-free and taking the other side, what they're doing is allowing retail traders to trade for free and then selling the order flow to hedge funds so they can profit from it, okay? So think about it. Why the hell would a hedge fund want to pay for the data unless they get a return on their investment? Well, you are the product, guys. When it comes to commission-free trading and the broker's data business, it's amazing how they gloss over by calling it a data business. It's just not free. You're paying somewhere else. You are the product. And this is the product that they're selling. We have tens of thousands of losing traders on our platform. Do you want to buy the data? They're selling their order flow and calling it a data business. They've got zero interest in you making money. In fact, it completely suits them if you lose because their data becomes more valuable. Okay. The order flow becomes more valuable. They literally get compensated for it. So if you're in the US and you're trading equity options, this is the number one product they sell now, the commission-free trading platforms in equity options. You literally might as well, at the beginning of the year, walk over to the hedge fund's office and just cut them a check. That $100,000 account that we looked at earlier, you know it's going to cost you $5,000 in borrowing costs. Okay. Additional to that, your order flow is being sold. Your limit orders are being sold to the hedge funds. And they can figure out where the market is, what the market positioning is. They can take the other side. They can do whatever they want. They can figure out multiple ways to make money out of your order flow. Okay. The point is that the broker's platform is just simply a conduit to transfer your wealth to the hedge funds. That's why the hedge funds are paying for it. Okay. If you're running a retail trading account on a commission-free trading platform, this is how their business works. It's unfortunate, but it's the truth. There are ways around it. Obviously, we'll get onto these later, but essentially the way around it is to not get involved in all of the things that they want you to do. It's to use their platforms to your advantage. Okay. Use the broker's platform to your advantage and trade like a professional trader. But let's get this down. Retail broker incentive number 3. Utilize the commission-free, the trade commission-free narrative to entice retail traders away from other brokers that charge a small commission. Set up the overnight financing so the parameters encourage day trading and you only live once options trades. Then sell that data to hedge funds for a per order fee and then wrap it and brand it as a data business. That's essentially how it works, guys. It's sad, but it's true. Conflict of interest number 3, commission-free trading, data business. So what does all this essentially mean? Well, retail traders globally, and we're going to look at the situation globally first, and then we're going to look at some of the nuances between Europe, UK, Asia Pacific, and the United States. Essentially splits up into the US and the rest of the world. Okay, but let's have a look at the conclusion here really for retail traders globally and why they lose money. So the approach and the similarities between US and rest of the world. This is what it really comes down to. There's 2 types of money in the market. There's the smart money. We refer to smart money as professional traders, and retail traders we refer to as dumb money. Let's have a look at the differences here. Smart money, professional traders, we understand how the financial markets work. We understand that conflict of interest exists. What we do, absolutely, is just avoid trading in the way that the participants with conflict of interest want us to trade. We do everything in the opposite way to the way in which retail traders do things. Okay, that's smart money. There's other ways of doing things, guys. Okay, it's the way pros do it. Now, what about retail traders, the dumb money? Whether you're in the US, rest of the world, doesn't matter where you are in the world. Okay, for whatever reason, I don't know whether it's laziness or ignorance or whatever. It's mostly ignorance. We've discussed this before, where retail traders obviously have full-time jobs, part-time jobs, run small businesses. There's family commitments. Whatever it is, life gets in the way, and you can't do the work to really understand how this works. Obviously, there's time to do it, and if you have any type of intellectual curiosity, you would go and figure this all out yourself. But we're here to do that for you, so you can really understand this and start climbing the hierarchy. For whatever reason, okay, retail believe, for whatever reason, that the infrastructure has literally been built and designed to benefit them. It's incorrect. When you actually study the infrastructure, the reality is it's been built to do the opposite, okay? It's been built to make sure that the business, the infrastructure works and makes money, okay? Not necessarily the retail trader. What ends up happening? Well, retail traders dumb money. They trade as they're told to trade by the participants that have conflict of interest. Essentially, they're doing everything in the opposite to the way in which professional traders do things. But, the way the market works as well, this is a reality, and it's unfortunate. Professional traders, the smart money in the market, requires the dumb money to actually exist, okay? Not everyone in the world, in the financial markets, can make money. The smart money does require ignorance and ineptitude to enable opportunities to occur, okay? So, if you're going to climb up the hierarchy, the competency hierarchy, and begin taking the professional trader approach, you're going to be in the significant minority. The rest of the retail trading market will still exist and be doing all this stuff, but you understand now that it exists, and you're starting to become more competent by just understanding it right at the beginning, okay? Smart money, unfortunately, requires dumb money to exist. Why? Because smart money doesn't look at the past. Smart money predicts the future. What ends up happening in the financial markets every day? Dumb money is reacting to the present, and wealth is just transferred. So the owners of the infrastructure, as we've looked at, brokers, etc., investment banks, hedge funds, the owners of the infrastructure need the dumb money to exist, and they need to maintain the status quo so they get paid. They will create any narrative to make sure that the status quo exists. They need the dumb money to exist, and wealth is transferred. Now, let's start looking at the differences between the rest of the world and the US domestic market in terms of retail traders. Let's have a look first at why retail traders in the UK, Europe, and Asia Pac lose money. Well, it can take as little as a day to open a retail brokerage account internationally, okay? Or even in the United States. You're going to be asked basically to provide some ID, usually a passport, proof of address, usually a utility bill, a tenancy agreement, whatever it is, okay? And you're going to sign off on some terms and conditions. And what it really comes down to is that in the terms and conditions, you're literally stating that you're aware of the risk that you're going to be taking, and that you can lose all of your money or even more, okay, because you're trading on margin, right? If you get a margin call, you're going to have to deposit more money into your account. So the legal risk is transferred to you. You're going on the platform and saying, I understand all of the risks I'm taking, and I'm prepared to lose all my money, okay, and more. So ask yourself the really obvious question, okay? Why is the retail broker willing to lend you, a complete stranger, a lot of the times 33 times the amount of money that you put into your trading account to trade the markets? Well, by now the answer should be really obvious, okay? It's because they get, in the rest of the world on international brokerages, it's because they get an 80, 90, 95% win rate on their losing client trades. They're literally incentivized for you to lose money, and they take the other side of your trades. They want to do this, of course, logically. Who wouldn't? They want to do this in the biggest size possible with little to no risk. So with the very fact that this infrastructure exists, what does it create? What type of behaviors does it create? Okay, from the brokers themselves. Well, the retail brokers are literally incentivized by the infrastructure to create a narrative that just increases your chances of losing money. So what is that? Well, trading as frequently as possible in the biggest size possible. And that's obviously so they can make more spread and commission if they're charging that. The financing turn has never gone away. That's still there. It's in Asia Pac, UK, Europe, and in the United States. Okay. And internationally, free trading platforms are now starting to be rolled out. So the data business as well. That's being rolled out internationally as well, outside the United States. So it won't be long till the open quotes data close quotes business will be prevalent in the rest of the world. So the data business, when it goes out, the buyers of the data are then going to be the entities that are going to take the other side of your losing trades. So exactly what we looked at earlier with the over-the-counter transactions that the brokers currently participate in, that's going to be probably transferred over to hedge funds internationally, and they're going to pay for it in the same way that it works in the United States. So they're maximizing their win rate and their revenues. So again, we're looking at a situation here where we've got some obvious conflicts of interest that lead to certain incentives, that lead to certain behaviors. And then retail traders are getting sucked into that narrative and then blinkered, and they think this is how trading should be done. It's obviously wrong. Now, what about in the United States? It's all very, very similar, guys. So there's not really big differences. As we've seen, the infrastructures, both internationally and in the United States, lead to retail traders behaving in very, very similar ways. Okay. But let's have a look specifically in the US. You know, everything we've discussed regarding UK, Europe, Asia Pac applies in the United States, just slightly differently. CFDs, contracts for difference, were banned in the US in 2010 after the global financial crisis. Why? Because of an extremely high percentage of retail traders lost money. Have the statistics improved? They haven't. They really genuinely haven't improved. There's obvious reasons for that, okay? All that's happened is that the infrastructure has changed, the business model slightly changed, and the brokers, investment banks, hedge funds, they still are on the other side of the wealth transfer, okay? In the United States now, retail traders are primarily using options contracts and futures at the index level in Forex and commodities to get leverage. Leverage in the US can actually also be obtained trading cash, physical equities through certain brokers. But what will happen is that it's 2 times margin for overnight positions, 4 times if you're day trading. That's on the underlying stocks. So if you're just buying or shorting a regular stock, so 50% to 25% margin requirement. So one of the differences between international and the US is that in the US, you will just have to make a larger deposit by retail trader standards into your trading account. Okay, typical 50% overnight margin requirement. Now, when it comes to indices, products, Forex and commodity futures, it's a lower margin requirement, but the tradable set is much, much smaller. The reason why you get more leverage when you trade at the index level or in Forex or commodity futures, it's because the volatility is much lower. So the brokers can actually provide more leverage for you to trade. Okay, there's less volatility. So the opportunity set is much smaller, volatility much smaller, so it's much harder to make money. Okay. Now, this is why options contracts have become really popular in the last 6-7 years in the US. Why? Because retail traders can deposit less margin and get implied leverage through options to the upside and downside of a stock. So if you're buying call options or buying put options or trading spreads or different structures, fantastic. You know, that's a good way to go. But there's other problems there because retail traders, vast majority, really just don't understand options at all. Okay. So this brings up other problems. This is covered in the Professional Options Trading Masterclass, the POTM video series. But the additional issues that we've discussed for US retail traders is that you're on commission-free trading platforms. You're subject now to a different business model to the way it used to work. All that's happened is that the business model has shifted where the financing turn is greater, and now you're exposed to a data business. Your order flow is being sold. So there are obviously very specific reasons in the US where there's differences with the UK, Europe, and Asia Pac. But also, when you're buying options on single stocks, indices, ETFs, etc., you're just going long call and put options. You can only lose the premium that you've paid. But when you're shorting options, trading spreads, etc., margin is definitely utilized, even if you have an offsetting position, an offsetting long position. So even if you're trading spreads, the problem in the US doesn't lie in the cost of overnight variable margin when it comes to options trading and options spreads. There's just two major issues as to why 80% of retail traders that trade options lose, and that's a low number. It's actually higher when you look at the numbers properly, but we'll use 80% for argument's sake. There's two major issues. One, the data business, which we've discussed, so trading for free and the order flow being sold, but also just trade idea generation. A lot of retail options traders in the US are only trading the option because the option is available. You should never trade an option just because it's available. First of all, you've got to have the trade idea, and then on top of that, structure the trade for the specific situation. And if you use options, it should be set up for the specific situation that you're trading, i.e. the trade idea that you've generated, not trading an option just because it's available. And the industry know this, guys. The industry know it, okay? The owners of the infrastructure know your weaknesses. If you're inclined towards options because you're just looking to get the leverage and you don't really understand what options are for, how they trade, how they're priced. On top of that, you don't have good trade idea generation with high quality ideas, okay? They are going to make sure that you are pushed into the options market, and in a way where what we call the inversion narrative is peddled. We'll get onto what the inversion narrative is soon. But essentially, if you're a retail options trader in the United States, the main reasons why the vast majority will lose most or all of their money over a fairly short space of time, we're talking less than a year, and in year 2, pretty much everyone's gone, okay? The main reasons is because the data business, your order flow is being sold, so your orders can literally be gained by hedge funds. Your limit orders, your stop loss orders, everything goes to the hedge funds now, okay? And second, your trade idea generation and the structuring that you use, okay? You only use an option dependent on the situation specifically for the trade idea that you've generated. You do not trade an option just because it's available and you think buying a call option is better than buying the stock because you get more leverage, okay? There is millions and millions and millions of victims who have taken that approach in the retail trading market, okay? But to make sure that the status quo remains, the brokers will push the inversion narrative. Essentially, the inversion narrative is the opposite of everything you should be doing, okay? Why? Because they're incentivized. They get paid more if their clients trade in the biggest size possible as frequently as possible, and if they trade short term. and especially if your trade ideas are terrible and you're just trading options for the sake of it. What happens over these time frames? We've looked at time horizon. There's less chance of catalysts and there's less volatility. These guys literally get compensated to push the inversion narrative to keep you unconsciously incompetent. Okay, so let's put this all together and have a look as a reminder why the vast majority of retail traders globally lose money and the incentives of retail brokers. We have our profit maximization formula here for the retail broker, where revenue is equal to spread plus commission plus financing turn plus OTC gain plus the data business. Let's have a look at their three incentives. Retail broker incentive 1, spread and commission, volume and size incentive. We don't need to labor the point too much here. Obvious, very obvious conflict of interest. Retail broker incentive number 2, providing the third-party financing with no risk to do it for the broker, and then taking a turn. Using the credit line to encourage retail traders to over-leverage and trade as frequently as possible. And internationally, not in the US, but internationally, take the other side of the losing client's trades using the credit. So that's a bonus. It's like a bonus on top. Wealth is transferred to the broker. Next up, if no spread and commission is being charged, like in the US with commission-free trading, and now it's being rolled out around the world, if a commission is not being charged or spread commission is not being charged, change the business model. Get them in another way. This is what they do. Utilize the trade commission-free model, the narrative, to entice retail traders away from brokers that are charging a small commission. Set up the overnight financing to encourage day trading, so you jack up the credit, the cost of the credit to trade overnight, which forces people to trade short term and even close out the same day. And also it forces people to be more irresponsible. So you go for big lottery ticket purchases like the you only live once options trades, the YOLO trades, okay? And then once you've got thousands of guys doing that, tens of thousands of guys doing that, you sell the order flow, the data, to hedge funds on a per order fee, and you wrap it up and you call it a data business. Massive conflict of interest, obviously, okay? So 3 major conflicts of interest there, guys. You've just got to take stock of it. Climb the competency hierarchy, get out of unconscious incompetence. And unfortunately, guys, the way this works, unfortunately, the only way to climb the competency hierarchy and get out of being unconsciously incompetent is to drop all of these ideas that you have, that the infrastructure was built to benefit you in some way. It hasn't been built to benefit you. Now, another part of the market where the narrative essentially keeps retail traders down and keeps retail traders unconsciously incompetent is, unfortunately, the vast majority of the trading education industry. We've all heard of them, trading educators. The Institute is one of them, but we do things very, very differently. If you look at what the other guys in the world who call themselves trading educators do, it's very, very different to what ITPM does. Literally the other end of the spectrum. 95% of trading educators on the planet, and this is something that you need to know from the outset, have some sort of conflict of interest. They have what's called an introducing broker agreement. So in every country where there's a regulator, licensed brokers, the guys that we've been talking about, the brokerage companies, they are, when they enter an agreement with an educator, they are legally required by the regulators to have an IB agreement in place, an introducing broker agreement. These have to be in place with any individual or company that introduces individuals onto their trading platform. So you go to an educator, they teach you some donkey day trading strategy, and then you sign up to their preferred broker. No doubt about it, there will be what's called an introducing broker agreement in place. Now, outside the United States, IB agreements are very prevalent and very aggressive, and they're all done on a spread and commission basis. So if the broker outside the US is charging a commission and you've been referred to their platform by an educator, it's highly likely that the educator is receiving a commission every time you trade based on the commission that you're paying the broker. And all IB agreements outside the US essentially pay between 20 to 50% of the spread and commission that's received by the broker. So if you pay the broker $100 for a trade, what's going to happen? The educator the following month will be invoicing the brokerage company for $20 to $50, something like that. Obviously, the agreements vary in scope, but the range is typically 20 to 50%. The brokers pay this back to the trading educator for introducing you onto the platform. On top of that, there's a minority of retail brokerage companies that actually pay in the rest of the world outside the US. They actually pay a percentage of the revenue obtained from financing the retail traders that the introducer, the educator, puts on their platform. So earlier, obviously, we talked quite a bit about the financing charges for overnight financing on positions. A percentage of that in some agreements goes to the educator as well. So you can see here, there's potentially a massive conflict of interest. In the US, an educator can't receive a percentage rebate unless they are fully regulated themselves as a broker. But they get around this, okay? They get around this if they're not regulated. They can either receive flat payments or they can arrange a soft dollar agreement with the broker. What do we mean by that? Well, first of all, flat payments is very simple, right? It's just flat payments for the acquisition of the client. They will set a flat payment. So, let's say you're an educator in the US, you teach someone some pokey day trading strategy with some technical analysis that guarantees they're going to trade 5 times a week or whatever, 10 times a week. They set themselves up as a PDT, pattern day trader, and they go and pay a certain amount of commission to the broker for that. Obviously, that's just on a continual basis until they blow up. But when they're introduced onto the platform, the broker might pay, let's say the guy puts 25 grand in his trading account, the broker might pay $500 for that client. Somewhere between $250 and $500 flat payment. So obviously, the educator is incentivized to keep giving the broker clients that pay lots of commission. Otherwise, the broker just wouldn't pay that flat rate. So they don't receive a commission per se in the United States, but they do receive a flat rate in the vast majority of cases. Soft dollar agreement is a situation in which, for example, let's say that a pokey day trader opens a 25 grand account and starts trading his way to zero. Obviously, the broker likes that because they're paying lots of commission in a very short space of time. A soft dollar arrangement would be on accounts that are slightly higher level in value. So maybe this guy could be 25, 50, 100 grand deposited on margin. And the broker may offer them some sort of charting package or software or something that goes alongside them opening their trading account and using the platform. Now, if they sign up for that for a few $100s a month, who do you think receives a commission on the software payment? The educator. Of course they do. So there's ways around it. It's very, very prevalent and very aggressive outside the United States. So pretty much everywhere in the rest of the world. The regulators in the US fully understand the conflict of interest. So they banned anyone receiving a commission as an educator a long time ago, over a decade ago. Anyone receiving a commission rebate as a percentage from the clients they introduced to the broker's platform. What's happened in the US? Well, they get around it by doing a flat payment and arranging soft dollar agreements. So again, similar to commission-free trading on the brokerage side, they will always find a way around it to screw you. The conflict of interest exists everywhere. Now, on the Institute side, how do we get around this? Well, if you go onto our website and navigate yourself on the top row, the navigation bar, to the accounts section, you will see the introducing broker agreements that we have in place with the brokers. So they have to be in place. That's not in doubt. The regulator requires the broker to have them in place. But we tell the broker to write something in the contract that no one else asks brokers to write, which is we want 0% as the rebate written into the contract so we can put it on our website and display that there's no conflict of interest at ITPM. So other educators, they have a conflict of interest because they have the same conflict of interest as the broker, which is size and frequency, spread and commission, and also financing term. We have none of that, okay? How this started out was around 2011, 2012, when people started asking me, when they started to join ITPM, which broker should they use? Of course, I started going to the brokers that had good platforms and started asking them what the deal would be if I introduced people, and they showed me these contracts, and I couldn't believe it. I could not believe that every educator in the market, in the retail market, was using these contracts. And then it was like a light bulb moment. I realized this is a major, major conflict of interest. And this is why so many retail traders lose money, because educators are basically doing the dirty work of the broker. They're like the front door. The broker is basically hiring them to do their dirty work for them, like a middleman. They are absolutely incentivized to only teach you short-term day trading or short-term strategies that are going to guarantee the broker and the educator big size and frequency in trades so they can maximize spread, commission, and financing turn payout in the short term. So what we do is we force them, and we've been doing this since 2013. They didn't like it to begin with, but they've warmed up to it, especially now since there's commission-free trading in a lot of places. We've been pioneers in this industry in making sure that zero gets written onto the contract. And they started doing it in 2013, and it's a lot more prevalent now. It's starting to get legs because of commission-free trading. So educators that used to receive commission and spread are trying to find new ways and struggling and scrambling. And we'll see how the future pans out. But these contracts that you can see on our website are very powerful. It gets everyone talking. It gets the brokers also questioning their entire business model. It gets the regulators' attention. So they start paying attention and noticing that there's a big conflict of interest, especially in Europe. So we've been pioneers in this respect. So anyone can see RIB agreements on the accounts page. So just go to itpm.com/trading accounts, and we upload them so you can understand how educators in the rest of the world and the United States operate. And this is an education in itself for a couple of reasons. First of all, it just shows that they exist. It's amazing how, even back 2012, 2013, I used to show these contracts in live seminars on weeknights in London, in New York at weekends, and no one even knew they existed. We brought this out and started showing the world, and it's a fantastic advertisement as to how the industry actually works. So first of all, it shows they exist. It educates people that they actually exist. And it shows how disingenuous the infrastructure is, retail brokers and charlatan trading educators, because they're incentivized in exactly the same way as the brokers are, by volume and size, okay? Also, what it does is it provides anyone who goes on that accounts page with a template. So you can actually take the links and forward them to your self-proclaimed educator, and you can literally just ask them, if they tell you to go on a certain platform, send me your IB agreement, show me your IB agreement. If they are introducing people onto a platform and recommending a certain platform, the regulator requires the broker to have an agreement in place. So they will have one. And what happens if they refuse to send it to you? Well, that's just confirmation that they have one and they're hiding something, okay? So ask them for a copy of theirs. Use the template. This will help change the industry. It's very, very important. It's much bigger than you can ever imagine, the effect that this has on the returns of retail traders. So all these guys who are peddling the short-term trading narrative, it's done for a reason, okay? There's a reason, an infrastructure, and an agenda behind it. It's because that's how they get paid, okay? They get paid because of the narrative that they push. So trading educators, whether it's in rest of the world, US, it's pretty much the same. They all have IB agreements. You can see ours in the United States and the rest of the world by going to the accounts section on our website. And some have financing rebates. So they're essentially brokers in disguise. They're incentivized by spread, commission, financing rebates. They're exactly incentivized in the same way as brokers are. They want you to trade as frequently as possible in the biggest size possible, so they get paid through the back door by the broker. So it's very obviously a conflict of interest, and it's totally in the brokers and the educators' interest to make people believe in what we call the inversion narrative, or the myths that are peddled by the owners of this infrastructure, okay? The inversion narrative, to break it down into very simple terms, they tell you everything in the opposite of what you should actually be doing to try and make money, to become consistently profitable like professional traders. Professional traders totally understand this. We know this infrastructure exists and we stay well away from it. Of course, if you're in the retail world, you have to open retail brokerage accounts. However, without any awareness and understanding of the owners of the infrastructure, what their conflict of interest is, and what they are pushing you to do on a frequent basis, without any awareness and understanding of that, you will end up falling into traps. Becoming someone who climbs the competency hierarchy starts at the bottom, becoming someone who moves out from being unconsciously incompetent. The only way that can be done is if you understand how this works and you drop these ideas. You drop the idea that these guys, the owners of the infrastructure, are on your side. They're not. You should be looking to do everything in the opposite that they want you to do it. If you just live by that mantra, you will probably find a way of being successful in financial markets. Of course, you need the right information to do it, but it's the first perfect start. You have to get out of being unconsciously incompetent, and this is where it starts. Step number one. Now, these bad actors, the trading educators, the charlatan trading educators. What is a charlatan? Well, it's somebody who's basically pretending to be something that they're not, okay? These guys have never actually been traders. The vast majority of them have never worked in an investment bank or a hedge fund. They're basically retail traders who have sat in their bedroom, maybe traded some retail trading accounts, and then they make something up like they've become a hedge fund manager or something. It's absolute nonsense, okay? They're basically just retail traders in disguise, and they're working for the broker. This is the way it works, guys. So you've got to be able to spot these guys and understand what the red flags are. They're all over the internet. They're basically online marketing, internet marketing, charlatan trading educators telling you that they have these amazing backstories, and they're just completely made up. The whole thing is made up. It's all designed to push you into the narrative so they get paid. Okay. Let's have a look at some of the ways they do it. Day trading always works. Well, we know that's not true. Okay. And we're actually going to prove this to you in later videos with numbers. It can't be true because the vast majority of day traders lose money. Okay. But this is what they try and plant as a seed in your mind, that you actually stand the chance. You don't. The statistics are horrific. You know, after 1 year, you're looking at 95% gone. You're looking at, even in the space of 3 to 4 months, 90% will lose the vast majority of their margin. By the end of year 2, even the guys that got lucky and made some money in the first year, they are gone as well. 100% will lose money over 2 years. Okay. We know that's not true, but they push this and push this and push this because they want you on the platform to trade in the biggest size possible as frequently as possible, because they get paid to do it. Okay. If you are somebody who goes on a trading platform and makes money and trades very infrequently and runs a smart portfolio, that's not something they like, because if they have tens of thousands of people that do that, what will happen? Their revenues go down significantly. Okay. Of course, there's a conflict of interest and they push the narrative. Next up, it's better to not have overnight risk and exit your positions before the close. So this is a risk management message that they give people. Okay. Close out your positions by the end of the day. Don't hold overnight positions because it's too risky. Blah, blah, blah. Well, that's because they have no idea about risk and they have a conflict of interest. Very straightforward. If you take a position in the morning and trade out in the afternoon before the market closes, they get paid twice. Okay. Even more if they're charging financing turn on the margin. If you hold the position overnight, they're going to get paid a little bit more, but they want you to keep turning over your account. Next one, preying on the desperation of the financially weak and the financially naive. You can make a monthly income from trading. Not true. There's no such thing as income from trading, as we've discussed in previous videos and will do in later videos. They push this narrative all the time, thinking that people will fall for it, and they do all the time, frequently fall for it. People will fall for it by telling them, you know, you can leave your job. Why are you going to work in a job all day, making X, making 50 grand a year, you know, when you can make 50 grand a quarter trading 6 stocks in the US stock market. Okay. Just day trading them and taking a monthly income. It doesn't exist, as we've discussed already. The retail traders introduced by the educators will obviously try this out, try to get paid a monthly income. What does that do? Well, it pushes you into the narrative, the inversion narrative, and what all you're doing is basically guaranteeing the broker and the educator a monthly income. That's what they're trying to do. They're trying to get paid a monthly income themselves. So they lie to you and tell you that you can get a monthly income from trading. And then what happens? You go to zero, and in the process, they get paid a monthly income, and the wheel keeps spinning. Next up, always making out that trading is easy, and all you have to do is follow a few simple rules, follow a few lines on a chart, some technicals, some momentum indicators. Basically, what they're doing is they're showing something that's very, very easily understandable to the financially weak, financially naive, and ignorant, showing them something that's really easy to understand so they feel like they've learned something, and then offering them a shortcut or a hack. So it's preying on desperation, preying on financial naivety, and preying on laziness. You know, at the end of the day, as we've discussed, all retail traders generally have full-time or part-time jobs or run a small business, have family commitments, have extra commitments outside of their job, outside of their business, whatever. Because of that, retail traders end up looking for quick, short-term solutions to get into the market to try and make quick money where they don't have to do too much work. You've seen it before. Guys going on chat rooms, taking tips from the TV, from the newspaper, from blogs online. You know, everybody's looking for a shortcut or a hack all the time. Guess what? If you display that you're financially naive, ignorant and lazy, there's an entire industry waiting to provide you the solution for that. But it isn't a solution. It's presented as a solution, so you pay for it. Okay. Unfortunately, trading's not easy. It requires a lot of work up front to learn the financial markets, which you're going to learn with us. And it also requires a lot of real money experience building and running portfolios over a decent to long period of time. So they're just telling the dumb money here something that they can easily understand to make them feel empowered. Essentially, what they're doing from a professional trader perspective is they're literally advertising that they have no systematic process of a professional standard and they don't even know how to trade themselves. It's obviously just a scam. So that's offering, retail traders, the financially naive and desperate, looking for a shortcut or a hack. That's basically, telling guys that all you have to do is follow these lines on a chart, and this is how you generate your ideas, and this is how you manage your risk. If only life were that easy. As you've seen up to this point in the video series, pro traders are using an entire process that takes into consideration many, many, many factors additional to that. This is just a tiny part of it. Another thing that they do, same principle here, where they're telling the dumb money something that they can understand and digest to make them feel empowered, and then offer them the solution or the hack on top of that, is to tell people all the time that psychology is really, really important. It's the most important thing in trading. All you have to do is get your head right and you will trade well. Unfortunately, that's absolute nonsense. Psychology is a small part of it, and it really just comes into understanding how to trade outcomes. But the outcomes for professional traders are very, very different to the outcomes for retail traders. And we understand that psychology is quite a simple process, and it comes down to experience. So your psychology becomes hardened over time, and you become more and more agnostic to risk the more experience you have. Okay. The psychology cannot be taught from a book. You can just understand some basic principles, but psychology cannot improve unless over a long period of time, you're implementing the right information and you're making consistent profitability, but experiencing losses in the process. Psychology will just get better over time, and you have to experience it for real. It can only be done for real. Okay. But of course, there's lots of content out there where, it sounds super intellectually sexy, where, the educators will tell you and massively overemphasize the role it plays because they don't have anything else. They don't know how to trade themselves. So they use this as a convenient tool to get you hooked. So you think you're learning something that empowers you to go out into the market and trade, and then they've got you. It's massively over-exaggerated. Again, this is the educator literally admitting from a pro trader's perspective, if they massively overemphasize psychology, that they don't have a systematic process and they don't know how to trade themselves. So trading is easy. This is how you get your ideas. Looking at a few lines on a chart, you manage risk that way as well. Psychology is the biggest thing and most important thing. And also risk management is the way you make money in trading. You don't need to come up with ideas. You just have to manage risk. Well, that's really stupid, because if you come up with really bad trade ideas and your psychology is good, let's say, and you think all you have to do to make money on bad ideas is to manage the risk well, I've got news for you. You're going to zero. Because if you throw trade after trade after trade, which are bad ideas after bad idea after bad idea, into a risk management process, all that's happening is that the risk management process is managing the risk on bad ideas. They will never go right. The upside in P&L, in dollar terms, is limited, and the downside is zero. If you do that, you're only going to zero. You're going to get caught out on a couple of trades at some point that go massively wrong, okay? And you'll just go to zero over time. Again, this is the same principle as the other two, telling dumb money something that they can easily understand to make them feel empowered. So they'll say, okay, all you have to do is have stops and targets. And as long as you manage your risk well, the quality of your ideas doesn't matter. That's complete nonsense. The quality of your ideas is everything. It's everything. Think of the reverse situation where instead of having bad ideas but good risk management, you have great ideas and average or bad risk management. What's that guy doing for the rest of his life? Well, if a very high number of his trade ideas are really high quality trade ideas and they on repeat go into a portfolio that has bad risk management, that person for the rest of their life is sitting back with their feet on the table. Because yes, maybe a few will go wrong, but the majority of them are going to go right. So that guy doesn't need to have amazing risk management. Now, obviously, if you're going to become competent over a long period of time, you need both. We're not saying just become good at ideas. What we're saying is that the message from charlatan trading educators is completely upside down. Why? Because they don't even know how to get trade ideas themselves. They have no idea. They've never been professional traders. They've never implemented a systematic trade idea generation process. So they wouldn't even know what the hell goes on at an investment bank or a hedge fund. They don't even know the first thing about building a proper portfolio. So again, what they're doing here is they're massively overemphasizing stuff that they have to concentrate on because they don't know anything else. And conveniently, it also gets people hooked because they don't understand it because they're dumb money themselves. And they pass that message on. And then dumb money in the retail trading industry, as in retail traders, get hooked by it because they feel like they've understood something and it makes them feel empowered. And then the educators hooked them. So taken all together, these three, trading is easy. Psychology is the most important thing, along with risk management. Trading is easy for trade ideas. Just look on the chart. Some rudimentary basic technical analysis that you get from a cheap book on Amazon. Follow some lines on the chart and some momentum indicators. Get your head right and have stops and targets. That's all they say. They massively overemphasize this because they have nothing else. And it seems like to you, you're learning something that's important because logically it makes sense. It's a tiny, tiny part of an overall professional trading process. What these guys are doing is obviously hooking you because you feel like you've learned something. But at the same time, from a pro trader perspective, if we see educators and that's all they push as their education, we know for sure, 100% guaranteed, they've never been professional traders because a pro trader would never just push that stuff. An overall professional trading systematic process is what you learn if you're at an investment bank or a hedge fund and you cover all bases. So they're just advertising themselves as charlatans. Now, last one is a big one, lifestyle messages as part of their marketing. So you'll see this all the time. Big houses, sports cars with quotes like, get the lifestyle you've always deserved, or one day you'll be like me, you can own the house and the car, etc., etc. This isn't just in trading, it goes into other areas of online marketing. This is a tool that's used to grab attention, get people to look at what they're doing and make inquiries because it gets people excited that they can make a lot of money in a very short space of time. Again, it's just a message for a retail trader that we're going to offer you a hack to get some sort of lifestyle that we have. Point is that most of them don't even have that lifestyle. Like the house is rented for a day off some website. They do some filming. They speak to camera. They rent the car for 1 or 2 days. And they're just full of absolute nonsense. Okay. And, real traders, although some live that way, most traders are in it for the game. They genuinely love the game. And we have to do screen time all the time. Okay. We're not sitting on beaches with a laptop and typing out, day trades in the morning with our left hand and then spending the day watching them and with our right hand drinking a beer on the beach and trading out with our left hand if we need to. No, we do screen time, and we're at our desk a lot during the week. And even if you're not working at an investment bank or a hedge fund, the screen time, mostly if you're working for yourself as a pro level trader, your screen time is basically doing statistics, research, data crunching, finding mispricings in the market. We're always, always, always looking to have an edge, okay? And that requires screen time. These lifestyle messages are absolute nonsense. What they're obviously trying to do, like the other examples, they're trying to get your attention and distract you away from what's important. So in this particular one, what they're trying to do is basically tap into your desperation. And many, many people fall for it, unfortunately. And we see many of them coming to us after they've lost their money. A lot of people who come to the Institute, they've experienced all this stuff that you're seeing on this slide. They've been operating at the level of unconscious incompetence for a long time. They then see our videos online, attend webinars and seminars, and then they start to get it. They understand that this is what you're looking at right now on the slide, the whole page. This is the inversion narrative. And this is what has kept them at the level of unconscious incompetence for so long. The good news is we've helped hundreds and thousands of guys turn around from being like this and falling for this narrative and losing money. We've turned them around and turned them into profitable traders that are essentially operating like professional traders because they're implementing all of the same processes, getting the same or better returns, but they're just not regulated. They're just not regulated traders and working for an investment bank or a hedge fund, but they're just doing everything in exactly the same way, but in the retail trading infrastructure. So this is the inversion narrative, guys, and something you should always remember, not just in the trading industry, just in all areas of business and all walks of life. When desperation meets conflict of interest, only bad things can happen. So when one party in a transaction is desperate, naive, unconscious, and then they meet someone who has an inherent conflict of interest in that industry or in that walk of life, only bad things can happen. Everything that these guys do, the charlatan trading educators, it's all designed to distract your attention away from the truth. You've seen how they do it. The main vehicle to do it is the inversion narrative on the previous slide. It's all designed to distract your attention away from the actual truth of how to become consistently profitable. Why? Well, first of all, they don't even know themselves. Secondly, it's so they get paid. Of course, they get paid by basically telling you the inversion narrative. Okay. The real truth is that everyone who they teach loses money. Literally everyone. Think about this, guys. They've been around for a long time, these educators. Okay. The statistics in the retail brokerage industry have never changed. Okay. They've never changed. Short-term traders, day traders, 90, 95, 100% over three months, 1 year and 2 years will lose the vast majority of all their money. They're all losers. Okay. So if the statistics have never changed and these guys have been around for a long time, like charlatan trading educators now have been around since the early 2000s. Okay. Late 90s, early 2000s. Okay. If the statistics have never changed, then what's the problem here? The problem is the charlatan trading educators themselves. They are the people that create the statistics. Okay. They are the reason they exist. And of course, the conflict of interest from the brokers, because the charlatan trading educator is essentially just a conduit for the conflict of interest that's inherent in the brokerage industry. And of course, the status quo and maintaining the status quo is the most important thing for the broker and the charlatan trading educator. They will go to extreme lengths to convince you otherwise away from the truth. They will go to very, very extreme lengths, stuff that you can't even imagine. We've witnessed it in the industry. It's crazy. Okay, they will go to huge, extreme lengths to maintain the status quo and make sure that tens of thousands of people, hundreds of thousands of people, millions of people will never actually get to know the truth. Now, in terms of the inversion narrative and what it looks like outside and inside the US, the inversion narrative, if you experience it online in the media, it's much more prevalent these days outside the United States. But it does go on in the US, and there's a lot of bad actors out there. The inversion narrative outside is more aggressive outside the United States, simply because commission, spread, and financing is more aggressive for retail traders outside the US. So what does it look like inside the US? Well, the conflict of interest still exists, even though it's a flat rate and soft dollar arrangements with the brokers. And the brokers themselves, from their perspective, they inherently want the status quo to be maintained. They want to be paid in terms of size and frequency and financing. Okay. So, and then of course, on top of that, with commission-free trading, there's a new business that we've discussed, the data business. So having lots of retail traders that lose lots of money frequently. That type of setup obviously means that their data is more valuable to potential buyers, because potential buyers can profit from the data of all of the losing traders, retail traders on the platform. So the brokers themselves, from their perspective, their conflicts of interest mean that, of course, they're incentivized to only contract charlatan trading educators that push the inversion narrative. The brokers are going to push the inversion narrative themselves, and they're only going to push educators and work with educators who actually push the inversion narrative alongside them. Think about it. If the educators' introductions onto the broker's platform don't trade frequently, a high percentage are profitable, so they actually have trading strategies that make money, then these guys are actually seen as annoying clients by the broker. Charlatan educators as well in the US, they need a home. So they need to work with brokers. Otherwise, they can't legitimize themselves. So when students go to these educators and say, I want to learn how to trade, and they give them some hokey, dodgy, technical analysis, price action, day trading program, and then they tell them that they should trade on a certain platform, the brand of the brokerage business gives the guy who's teaching that legitimacy. Okay, so they use the broker to legitimize themselves. The problem is that they still work for the broker. They know exactly what the broker wants, and they know the broker will not work with them unless they push the inversion narrative. So they may not talk about it out loud. Many do, by the way, but they may not talk about it out loud with each other in a room. The inversion narrative and how they're going to work together to get more clients and losing traders. Okay. But they signal to each other. So a broker may refuse to work with an educator if they realize that all of their clients are going to be annoying, or a big majority of them are. So they're going to favor, obviously, to maintain the status quo, they're going to favor charlatan trading educators that push the inversion narrative alongside them. Now, this brings up an interesting point. How do we get around that at ITPM? Well, pretty simple and straightforward. A lot of the meetings that we had over the last 6-7 years with brokers, we just said, keep our business separate from the pool, put it in a bucket elsewhere within the brokerage company. You'll have hundreds of guys at ITPM who open trading accounts. and we don't want to be rebated. We don't want anything. Put 0 on the contract, and we'll put the contracts on the website so everyone can see them. And essentially what we are offering you a hedge to your traditional business. So you'll have the infrastructure in place, and at some point when your traditional business starts to unwind and collapse, which it inevitably will do, you will have the competitive advantage over other brokers because you guys will already have the infrastructure set up, and you'll be able to scale it up for all of your retail traders across the entire platform. And many didn't want to do it, but a few did. And many more are warming up to it now, and they will do in the future. So we've genuinely, with our IB agreements and with our negotiations with brokers who are smart enough to realize that their traditional business is probably going to change very quickly at some point, we've actually managed to make a big dent in the retail brokerage industry. And we've been forging a path for the last 6-7 years for retail traders and our community. And they now have to pay attention because our retail trading community is pretty big. And we have a lot of consumer power, if you want to put it that way, when we go shopping for brokerage platforms and where we're going to send our business. So it's worked. And unfortunately, the retail trading industry is yet to catch up, whether it's outside the United States or inside the United States. But, you know, if you're watching this now, no doubt about it, ITPM and having the arrangements that we have with the brokers that we trade through, probably one of the safest places in the world to actually learn and trade your money through the infrastructure that we provide. But as I say, you know, the retail trading industry, it's fraught with conflict of interest. You know, we've obviously looked at the infrastructure, the owners of the infrastructure, and also charlatan trading educators. Retail traders really just don't understand that this all goes on and that the odds are always stacked against them. And essentially, they're just pawns, lemmings being used to make all these guys money. This is where it begins, guys. Unconscious incompetence and climbing out of the bottom of the competency hierarchy. When it comes to charlatan trading educators, red flags, you got to watch out for them. Hiding their IB agreements. We've seen that. You should ask for it. If they're introducing you onto a platform, the regulator absolutely requires the broker, they must have an IB agreement in place with the educator. Second, no regulated history. Very simple, guys. Wherever you are in the world, if some guy is telling you, I am a professional trader, or I am someone who used to be a professional trader, you can go on the website of the regulator of your country or the domestic that this guy claims that he was a professional trader or is a professional trader. You can type in their name, you can do a company search, and you'll see if they were regulated or not in the past or currently. If they've never been regulated, it means they have never worked at an institution and traded as a professional trader. There is a definition of a professional trader, and that is somebody who has been regulated in the past or currently regulated to trade other people's money, OPM. What do we mean by that? You're trading client money or shareholder money. So as we discussed in previous videos, hedge funds, investors, clients, investment banks, shareholder capital, and then pension funds and hedge funds coming into the bank to trade. You cannot even make a decision as a professional trader or speak to these people on the phone, okay, unless you're regulated. So you have to take your exams and be regulated. And once you're regulated, you're allowed to speak on the phone, email, whatever form of communication with investors, clients, and you can trade investors, clients, and shareholders' money, other people's money. If you've never been regulated, it means you've never been a professional trader, because that literally is the definition of a professional trader. Now, what does that mean? Well, it means you've been in the professional trading environment, you've traded portfolios, you've traded client money, So you know exactly what goes on in the world of professional trading. You know exactly what professional traders do because you've done it yourself, you've lived it, you've breathed it, okay? If you've never done it and you call yourself a professional trader, that means you're a liar and it means you're a charlatan, okay? Simple as that. It's really that simple. So you can go on the regulators' websites, you can check their names, check their companies. If you draw a blank and nothing comes up, it's a massive red flag. It means they're lying to you. It means they're telling you that they are either a professional trader now or in the past, and it means they've never been regulated. So they could not have possibly been. So you need to bring it up with them. And if they're lying to you about that, it means they're trying to win your confidence for whatever reason, but we know what the reason is. It's so you go onto their programs, pay them money, you learn some really shitty information, and then you just put money in your trading account and you trade all the way to zero. You'll just become a statistic, okay? They have no idea what they're doing. They've never experienced professional level trading, and they're lying to you. Now, next, manufactured backstories. Manufactured backstories are very prevalent. I turned $500 into $1 million using my super secret method. You've seen it before. Complete nonsense. These guys are basically, telling you that they're like the super kid that, traded from their bedroom and made lots of money very quickly. And then you can benefit from the same approach if you just join their chat room and take their education. It's all designed to get you in to pay subscription fees, and it's all designed to get you in to day trade, short-term trade, so the broker gets paid and soft dollar arrangements are paid. This is how the industry works, guys. Starting to become more conscious, get out of the level of unconscious incompetence. Next one, manufactured trades or deception. Very straightforward. They'll have fake equity curves, fake track records, spreadsheets that are put in the back of websites that upload supposed trades that they've done. They'll go on Twitter, they'll go on blogs, they'll go on whatever channel to basically tell you that they traded something yesterday or today or earlier. Put up a screenshot of a chart, and you might even get people going to extreme lengths by putting up a screenshot of a trading account and showing you in the trading account how much money they made on the trade. There's a big problem here, guys. It's the oldest trick in the book. It's the oldest trick in the brokerage industry, which is to basically have two trading accounts, one where they go long and another one where they go short, and they take the screenshot of the one that worked. And then they put it up on a channel, whatever that channel is, and then tell you they did the trade. And then obviously you can do the trade as well, or trades like it, and benefit from the same approach. All complete nonsense. Anyone who sits around taking screenshots of their account and putting them on a website or on a channel, and then telling people that they can do the same, why are they doing it? It's to win your confidence, because they want you to sign up. They want you to subscribe, okay, to whatever they're selling. We just don't engage in stuff like that at ITPM, because if we did that in professional circles, we would be disowned, okay? Like we would literally be thrown into the same bucket as all these guys. We've got absolutely no interest, because these guys are obviously deceiving people. From a pro trader perspective, it's very obvious that they're deceiving you, okay? It's to win your confidence. And next up, we talked about this earlier, the lifestyle narrative. You can own the house, the car, etc. It's the pitch, okay? So that they're painting a very, very easy, glossy picture. And unfortunately, all of these 5 main red flags, you're going to see them all the time. I would say even if you see 1 or 2 of them, major red flags, just stay away. It's really obvious to us as pro traders that guys that are engaging in all of this stuff, that any of the 5 major red flags, it's really obvious that they've never been professional traders. And, as a reminder, as we've shown you earlier, professional traders, we are located in the 20 to 60 day time horizon. And the approach with professional traders has really genuinely never changed. This is the sweet spot for volatility in the market. So we go to the area where we get the most opportunities and the consistent level of volatility that's required to enable us to get consistent wholesale opportunities for trade idea generation, and the level of volatility that's going to give us consistent or potential consistent profitability over a long period of time, over many, many trades, because we are portfolio managers, okay? The guys like the charlatan trading educators, the retail brokers, the guys that are pushing the inversion narrative, where are they pushing you to? On the time horizon spectrum, they are pushing you to the 1 day or the 1 week time horizon, okay? They want you to trade in as big a size as possible, as frequently as possible, and for you to believe in the narrative that they're pushing, okay? Because it suits them. It suits their infrastructure. It's how they get paid, and it's their conflict of interest. How do you again know that these guys are charlatans? Well, you now know what a professional trader systematic process looks like, okay? This is what it looks like. The vast, vast majority of professional traders will use this pro trader systematic process or something very, very similar that looks like this. The variation won't be much different, okay? And they will go from start to finish, fundamentals through quant and qualitative processes, timing, trade structures, varying trade structures for the ideas that are fundamentally driven and timed well. And they will build portfolios, and they will manage the risk of those portfolios as best as they possibly can. And they'll do all of this within the 20 to 60 day time horizon. And if volatility increases, sure, they will slide down the scale to try and make shorter term profits. But the vast majority of time, they will be located in the 20 to 60 day time horizon, implementing a pro trader systematic process within the remit, the mandate of long short portfolio management. And they'll be doing this over and over again because it's the place to be in the market in the 20, 60 day time horizon, where they get the biggest amount of opportunities on a consistent basis, and they get the volatility that they require to get the returns that they're looking for, okay? The bad actors in the retail trading industry have never even seen anything like this because they've never actually been professional traders, and they don't even know anything that professional traders do. So in terms of time horizon and the pro trader processes, we have obviously as pro traders very different definitions as to what constitutes a trade idea to retail traders and the people who are teaching them and the brokers and owners of the infrastructure, okay? Let's have a look at some of those differences. So let's have a look at the most simple one, the difference between a day trade or short-term trade and an investment, okay, versus an actual long-short portfolio manager. What is the difference? Okay, well, first of all, an investment is not a trade idea. So, if you're a retail trader or consider yourself a retail trader and you hold positions over 6 months, unfortunately, you're not a trader, you're an investor. So we're looking here at 3 months and below as the definition of trading, open quotes, trading, close quotes, okay? If we look at the 1 day time horizon day trades, what are guys actually doing? Well, they're essentially just trying to front run or scalp order flow in the market. They're looking at technical analysis and price action indicators, minute to minute candlesticks. It's 100% of what they do in order to generate an idea, okay? The reason why they take a position. It's all very short-term news flow, very short-term decision making, and quite frankly, it's all just noise, okay? It's not based on really anything, okay? Investment, 3 to 5 years, all based on fundamentals. Of course, it can be growth or value ideas, but anything over 6 months, guys, anything over 6 months is an investment. That's what it's defined as. And then, of course, we have that gray area between 3 and 6 months. Anything under 3 months is considered a trade. Problem is, if you're an investor, what do you have to do? Well, you have to sit around literally for 3 to 5 years to find out if you're going to be right or wrong. And actually, as retail traders, very, very difficult for you to have an edge in the market and be a really good investor. It's more likely the case that you're going to be wrong on most positions. What about you only live once retail trades, YOLO trades? Of course, they can be short-term positions, or they can be investments. YOLO trades can be 1 day, 1 week, or investments. But what are YOLO traders doing in practice? Well, they've got their trade idea from somewhere else. Whatever the channel that they've been to, whether it's a chat room, a blog, social media, TV media, newspapers, whatever, okay? It's all the same. You're just going somewhere else to get your ideas and not generating ideas yourself. You're essentially copy trading. You're being fed a diet of media narrative, and you're fully subverting to the narrative, and you're going all in on a position. That's what a YOLO trade is. These differ very, very differently. They're very, very different to what professional traders do in the 1 to 3 month time horizon in long-short portfolio management. As we've discussed previously, in the long-short portfolio mandate 1 to 3 months, we are predominantly in fundamentals. We've put 80% here. That's really a low ball number. It's at least 80%, if not 90%. Okay, and then technicals, price action, are essentially, if your fundamentals are 80%, 10 and 10, if they're 90%, 5 and 5. It's in the vast minority of what you do in terms of technicals and price action. It's only used for timing positions that you already have a fundamental bias on. Then on top of that, because we want volatility in 1 to 3 months, we find ourselves in the areas of the market where we can get that volatility, where we've got wholesale opportunities. And we look for catalysts that are going to move the stock within the 1 to 3 month time horizon. When we've identified our catalysts and we're ready to take a position, we go and check all of the pricing in the market for all of the differing trade structures, and we try to maximize efficiently our trade structuring and our return on investment, our ROI. Then, of course, when we're trade structuring, we have to consider risk management, and we have predetermined portfolio rules that we will transpose onto the portfolio before we even have a position. This will be diversification mainly, and also lower correlation. This is preemptive risk management, PRM. And then once we have positions and we have a whole portfolio, when news comes out, when things happen, when winners present themselves, when losers present themselves, when the portfolio is moving around, when correlation moves, etc., we have what we term reactive risk management. We're busy doing things and we're staying in motion. Now, this is what all students learn in the Institute inside the PTM video series and the POTM video series. In the IPLT, what we're doing is we're introducing you to the differences at the moment between retail traders and professional traders. And in all of this video, what you've really seen is the bad ideas and actions that keep you unconsciously incompetent. In future videos, what we're going to show you is the actual numbers behind all of this. So as we keep going through the IPLT video series, what's going to be happening is you're going to be waking up and you're going to be starting to see numbers and starting to understand how to do processes for yourself to understand where the opportunities are in the market. And you're going to start lifting yourself out of the unconsciously incompetent area of the competency hierarchy where retail traders generally exist. Now, where do institute traders exist? Well, institute traders generally exist in the conscious level because they're implementing. They've learned our online programs or they've done mentoring programs, and they've traded with real money. They're either just starting out or they're fairly experienced and they're starting to get profitable, and they generally exist in the conscious area, either conscious competence or unconscious competence. So for you to get from unconscious incompetence, you have to be doing the IPLT. and then learning the PTM and POTM video series content, and then opening your trading account and starting to trade. And then you get into conscious competence. And then, of course, when you become experienced, you're consistently profitable. 9 to 12 months down the track, you can lift yourself into unconscious competence. So this has obviously been a very big video and big learning experience. Let's put all the main points together and conclude before we move on to the next video. There's a genuine, real difference between the way retail traders do things and professional traders, how pro traders approach the financial markets, and how retail traders do things and how they approach the financial markets. There's a real, genuine difference. With pro traders, the most important thing is to first understand the parameters of the industry that we're operating in. And then we go about strategizing how best to approach the market within that industry. So we're taking the smart approach, okay? Retail traders just don't do this at all. And they make all the dumb mistakes, the dumb money mistakes. And they just never learn from them. So they keep going round in circles and operating at the level of unconscious incompetence. The mistakes that retail traders make, professional traders never make those mistakes. They are literally on the other side of the fence to retail traders. Now, once the infrastructure of the industry is understood by pro traders, we know that the only way to become consistently profitable is to understand volatility first. And then we target the risk and reward, so the opportunity that's available within the parameters, okay? The market dictates the opportunities to us. So we know as pro traders that when we target the risk reward, we have to have a robust and repeatable systematic process in order to get consistency in returns on a risk adjusted basis. So this is what we were talking about right at the beginning of the video. How much return you get from the risk that you take, your Sharpe ratio. And we build long, short, 1 to 3 month time horizon portfolios. Now, what ends up happening with retail traders? Well, because of a retail trader's lack of understanding of the industry infrastructure and the conflict of interest, they end up doing what the participants in the infrastructure who exhibit conflict of interest want them to do. They end up doing the opposite of what professional traders do, which is to be the losers within the infrastructure. They day trade, they short-term trade, and then they invest over a long period of time. So they end up being at the polar opposites of the time horizon spectrum, which are essentially the areas of the market that rarely pay. So because of all this, retail traders spend their entire existence just going round in circles at the level of unconscious incompetence. And there's no real understanding of how the infrastructure works, the conflict of interest, why they're losing money, and mainly why they're losing money due to a lack of volatility and therefore risk and opportunity. They don't have a systematic process in place that identifies high quality trade ideas and allows them to time trades properly, structure trades properly for high ROI and reward to risk, and both preemptively and reactively manage their risk effectively. Something else that retail traders don't fully understand is that just having a process is not enough. Pro traders understand that they still need to get a higher return from the risk that they're taking. Otherwise, it's pointless, okay? If you're making money, great. But if you're taking higher risk than the return that you're getting over many trades, over a long enough time horizon, you're going to come unstuck. You're probably going to have those 1 or 2 nightmare positions that go wrong because you're taking a lot of risk and the volatility is too high, okay? And you're probably going to end up eating some big losses at some point. Now, overall, in this video, if you've understood what we've displayed to you in this video, if you've understood this, you're now officially waking up. You're officially awakening from unconscious incompetence. To get to the next level, to become consciously incompetent, you've got to continue learning and put some real meat on the bone here. We're going to do it for you. It's now all about numbers. So let's move on to volatility. When we move on to the next video, before you do that, there's a PDF download to this video. Make sure you go through it and understand some basics on statistics. It's a PDF that with some statistics in there that Chris Quill has put together, and it's very comprehensive. If you go through that, understand the basics of statistics, and you'll be equipped to move on to the next video where we're going to apply the statistical principles of the PDF onto the financial markets, and we're going to start putting some meat on the bone, numbers, and we're going to look at the most important thing for risk and opportunity, volatility. Let's go over to the next video.